Okay, let's start with equity investments. Perhaps the easiest of all the topic, isn't it? So interesting. Something that you have done in level one and in level two, it's just a repetition of it, right? Most of the things. I'm not saying everything is repeated, but most of the things you all are already aware, and this is perhaps the reason why people do CFA, correct? Now, when you were probably doing the full course, it took a lot of time, but in the revision, it is not going to take a lot of time because you will see the interconnection between the topics. Yes, for example, dividend discounting model, free cash flow, all those are interconnected. The philosophy, the technique is the same, right? In fact, you will see many of these formulas are same, correct? Now, these six readings will begin. So let's begin with the first reading, application and process. As I said, I'm going to highlight on the key things. What you will also do is that you can highlight these things in your notes while doing the notes for the first time. We had highlighted these things, but you can redo it again. You can probably use a different color highlighter for revision, because when you do it for the first time, you are marking probably everything. This is what I used to do. But for revision, I used to have a different color marker or a different color pen just to highlight those things which are revision essential. Okay. Many of these theoretical things, I will leave it up to you. I would suggest you to go through it because it is repetitive in the part. Some things which are essential, which I will take it in the session, right? Because we have a limited time, we cannot cover each and every aspect. So I will focus on the key things. However, even after the session, if you think you need some extra information on any of those things, you can come back to me. You can send me a text message or you can reach out to me. But my suggestion is, as I said, don't deviate too much from the syllabus. The actual exam is not as difficult as what it looks like. The syllabus is very daunting. The syllabus is very vast for level two. But my experience is that the level two exam and the results are not so bad. In fact, they're much better than level one. I'm sure you all are aware, right? So the key is finishing the syllabus, revising it, and not deviating too much. And yes, of course, doing a lot of questions. Perfect. All set. So let's start with application and process. In this topic, we majorly focused on one of the formula. The only formula was related to mispricing. Apart from that, it was just a beginning of what the six readings are. So there's no complication in this thing. Remember, level two is all about valuing an asset. Correct? That was the key. And the asset valuation, as per an analyst, is what we call as intrinsic value. That is the term that we used. Correct? But this intrinsic value that the analyst thinks and what the actual price is, the difference between both is called mispricing, isn't it? So what is mispricing? Mispricing is the difference between the price that the analyst thinks, that is the intrinsic value, and the actual market price. This is the first formula that we learn, right? This is the mispricing. So you can write with me simultaneously, what is mispricing? Mispricing, correct? This is basically, we are doing a reading one. I will write down the details of the reading one later. Mispricing is difference between two things: intrinsic value and the actual market price of the stock. The difference between both is called your mispricing, correct? However, intrinsic value as per whom? As per the analyst. Intrinsic value as per the analyst. But the important thing is that how do we know whether the intrinsic value that the analyst got is accurate or not? So what we also do is that we find out what is the actual mispricing and what is the valuation errors. Yes. So the mispricing is further divided into two parts. One is the actual mispricing, and the valuation error. Valuation error basically focuses that the analyst can be wrong. The analyst derived intrinsic value may be based on the fundamental knowledge that the analyst has. He's a CFA or she's a CFA and she did the valuation. But how do we know that the analyst's intrinsic value is same as what it should be? That is valuation error. So valuation error is basically the difference between the intrinsic values, one that the analyst thinks, and second, what actually is the intrinsic value actual, because analysts can also make mistakes, right? That's called my valuation error. And what is actual mispricing? Actual mispricing is, by the way, deviation of the intrinsic value, what it should be. So actual mispricing is intrinsic value, what it should be, that is as per the analyst or the actual mispricing. Actual mispricing, the word itself says actual. So actual mispricing is intrinsic value, what it should be actual, and the difference between this and the market price, the actual market price. Correct? So this is going to be my actual mispricing, that is actual market price. Now, if you combine these two, you will eventually get the same thing. If you will notice this, when you combine these two, the intrinsic value actual gets cancelled out, and then only thing remains is that the intrinsic value as per the analyst and actual market price. Are you with me on this? Everyone, check, check, check. This is called my mispricing, and mispricing is divided into two parts: actual mispricing and valuation error. There is a very high possibility of this being asked in exam. All set, everyone? Check out here. So this part is my mispricing, correct? Of this, which is actual mispricing. And this part is my valuation error, because the analyst can also go wrong. All set, everyone? Right? This is your first important thing. Second thing is that we have some assumptions throughout the syllabus, that we are assuming that the company is going concern, means the valuation for a going concern company and for a company which is going to get liquidate or shut down is completely different. We are assuming the business is going concern. So we are going to value most of the companies from that point of view, right? Now, intrinsic value, what exactly is intrinsic value? Intrinsic value is basically the value that the analyst thinks is relevant based on the knowledge or the information and the best decision that the analyst thinks. But there are simultaneous names for these intrinsic values. Sometimes we use fair market values. This is the value, this is what we call as the hypothetical value, right? Of a willing, informed, and able seller. Someone is willing to sell at a proper market price. So fair market value is from the seller's point of view, correct? Also, we use fair market value in many cases for financial reporting. When you are using cost or revaluation model, at that time we use fair market value. And we use investment value also. Investment value is basically from the buyer's point of view, someone who's going to take over the company. So from their point of view, what is the value is called investment value. So yes, intrinsic value, fair market value, investment value, multiple names for the same thing. Just before that, let me also highlight this, that when the company is assumed to be going concern, means we are valuing the business, means it will continue. But when we think that the company will not grow or the company is going to shut down, we use liquidation value. Am I correct? However, there is one more form which is called orderly liquidation value. It is something when you're planning to sell off the business over a period of time. If you're going to do it immediately, liquidation value. If you're going to sell off over a period of time, it is called orderly liquidation value. Everyone with me? Check, 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 check. Correct? Okay. Yes. The first topic is just introduction, very basics, right? Valuation. Throughout the syllabus, we are going to do valuation. We are going to do valuation using the discounting cash flow technique, using the multipliers model, where we are going to compare a company with the other peer groups in the market. And there are general steps in the valuation, which you do not have to memorize it. But remember, valuation is not about just the numbers. You need to understand or have an idea about the business model of the company. Then you need to forecast the performance. This is what we do in the financial modeling, right? But throughout the syllabus, we are going to use different models. We are going to use discounting cash flow, P based, EV EBITDA based. So we will select an appropriate model. Then we will convert the raw information 10K report into forecast and valuation model. This valuation is framed up in a report. This report is concluded whether to buy or sell the company. That is what the conclusion. Without conclusion, there is no valuation sense, correct? So simultaneously, we have discussed what are the different uses of valuation. You can just read them. Valuation is used for various purpose, from the buyer's point of view, from the seller's point of view, having an idea about the market, about the company's business, valuing for private business, public entity, also part of your portfolio management process. Remember, in PMS, there are three steps: planning, then there is execution, and then there is feedback or monitoring. So in execution is where we are going to select the securities. That's where we will require the valuation fundamentals, correct? So these are the various reasons which we have covered in much in detail during our full course. These are some of the reasons. No rocket science here, no brainer required, a very basic information. What is important here is that when we are going to do the first part, remember the first part of valuation is understanding the business. This is where we use a top down approach. Correct? What is a top down approach? Top down approach. Top down approach is where we are going to do understand the industry and the economy, right? We are going to do industry analysis and economic analysis in order to decide whether the business in which the company is, whether that is feasible or not, whether that has a potential or not. We are going to check out for the earnings quality, correct? Whether the business is sustainable, whether the industry has potential or not. This is where comes Michael Porter's five forces, which you have seen throughout your level 1 syllabus also. Threat of new entrants, bargaining power of buyers and suppliers, threat of substitutes, and competition, rivalry amongst the existing players. These were the important elements in your top-down approach. Remember, top-down is where you analyze the economy and industry first. When it comes to the bottom-up approach, which is the company analysis. So this is industry analysis, company analysis. Companies generally use two important things to gain the market share, right? One is they should be cost leadership. They should be the cheapest producer, right? That happens with economies of scale, like in case of China, or product differentiation, where your product is so unique like Apple that people have to buy it. The third thing is focus. Focus is a blend of both, where you may use either of the strategy at different stages or different time period, and you can probably use both the strategies, right? So this is where I would say that cost and product differentiation is what Taiwan has, where they are, they are cost effective in terms of semiconductor, and as well as they have expertise in it, correct? Right, everyone? So these are the elements in company analysis. All right, right. Then there are various things regarding the quality of your financial report. Remember, earnings qualities, whether the earnings are sustainable and sufficient to cover your cost of capital. Financial statement quality basically focuses on the warning signals. Yes, those are the warning signals which tells you the quality of reports. Whether these are related to corporate governance issues, there are many examples related to it. I'll just highlight those. Accelerating or revenue or recognition of income, that is called aggressive accounting. Am I correct? Right? Reclassifying gains and non-operating income as operating, that is also aggressive accounting, right? Expenses recognition and losses, dealing of them by capitalizing rather than recognizing an expense, right? Amortization, depreciation, this is where we use a lot of subjective elements. These are all for pension liabilities. Getting the present value, that is so subjective. Management can change the numbers, change their expectations. Off balance sheet items or off balance sheet transactions are when companies create various complex structures like SPE or uses some leases. To avoid to avoid a negative picture on the balance sheet, they use lease, short-term lease rather than long-term lease, because that will be then considered as a liability, right? All of these are off balance sheet systems or issues that you need to highlight when you're looking at financial reporting quality. Some of the warning signs are given for poor quality, which you can read it or you can simply just go through it in a nutshell. It is not nothing rocket science here. Throughout the syllabus, we are going to use two broad models. One is absolute valuation model and second is relative valuation model. Absolute valuation models are those which are based on dividend discount model, free cash flow, and residual income approach. Yes, the third one, which is new, dividend discount model, free cash flow approach, and residual approach. These three together are your absolute valuation model. However, we will also use asset-based valuation model, which is generally used for companies which are going to be liquidated. All of these are absolute valuation models, right? Because they are individually done on a company. Relative valuation models are where you are going to compare your company with another industry or peers in the industry. You're going to compare with them. So those are relative valuation model, like your PE-based valuation model, price to sales, price to book value, EV beta models. All of these will tell you relatively whether your company is undervalued or overvalued. Those are the two broad valuation models that we are going to use. Correct. Then we need to understand sum of parts and a conglomerate. Sum of parts is where we break up the company and value each line of business differently. Yes, that is called sum of part. Sum of part, I'll repeat, where we break up the company into different parts. For example, onshore, offshore, oil and drilling, uh, gas. All these are different lines of operations or business for an oil and gas company, right? Gas distribution, a different business. So when we value each part separately, that is called sum of parts, right? Sometimes the value of the business individually is much bigger than the combined valuation. Then we are going to look at conglomerate discount. In fact, we are going to calculate conglomerate discount when we will do private company valuation at the end. Remember, one of your last topic is private business valuation. Private companies valuation, where we are going to do conglomerate discount. What is conglomerate discount? Is when a company is as large as Amazon, Google, or let's say a bank like JP Morgan. What happens is that they are running so many multiple operations that they might lose the focus and not have that high efficiency. So in this case, what we do is that we do a markdown of the value. We apply a discount to the valuation of the company. Why? Because we assume that the company is not having as high as value as compared to those companies which are only focused on that lines of operation. So they've given three explanations for why to apply conglomerate discount, right? Because of internal capital efficiency, that, imagine a company which is just focusing on gas, that will be much efficient than the company who has oil, gas, and different petrochemicals, right? So who's going to allocate the capital more efficiently? The company which is only focused on a business, rather than a conglomerate which has to allocate amongst different capitals. Second is internal factors. Company may have pursued unrelated business acquisition because of lack of corporate governance, where they are trying to hide out few things. It's a management mishap. So those can also be the reason of going into these multiple businesses. Therefore, they might not be efficient. And third is very silly, which they are saying that this conglomerate discount may be just because of the valuation error. In reality, it might not exist. So these are the three reasons of having a conglomerate discount, generally applicable for large companies which are doing multiple lines of business. Got it? Now, which approach is appropriate for my business? It depends on various characteristics. For example, we need to see whether it fits, the valuation model fits for the company. For example, a company which is a startup might not be in the position to pay dividends or might have negative earnings. In that case, what valuation should I put, right? Also, it depends on the quality and availability of data. If it's a private company, it's very difficult to get the data. And what is the objective? Why are you valuing the company? Are you going to buy the business? Are you going to sell the business? Are you a long-term or a short-term investor? So understanding the suitability or the purpose of analysis. These are the three reasons majorly, because, or three considerations that we should take into account when valuing a company. Got it? Over the period, you will see different valuation approaches. These valuation approaches also differ from the point of view whether you are going to take a controlling interest. Controlling interest means you're going to be a major stakeholder, or you're going to be a minority stakeholder. Accordingly, the different valuation models will be there. Correct? Also, it does matter whether you're going to take over that company or invest in that company based on cash, or if it's a merger and acquisition, are you going to sell, or are you going to give them your shares? So basically, whether you are going to do the deal on basis of cash or shares, that is also important, because if you it's a controlling stake, it does matter that if it's a controlling stake, then the dividend policy existing can be changed by you if you're going to be the controlling stakeholder, because the board of director has the power to decide on dividends. So accordingly, the models will change, which we will see throughout the syllabus. Got it? Overall, in this topic, we just have one formula that is related to mispricing. Mispricing, actual mispricing, and valuation error. Correct? Together is what we get to know the mispricing. Very, very often asked in exam, very highly asked in exam. This is what the mispricing is. This topic is just the beginning, just an introduction. A more detail is going to be the next topic of dividend discount model and free cash flow based model. These are the most important topics amongst all the topics, and majority of your questions are going to be from these readings. So since we are done with the introduction, right, what we'll do is that we'll move to the next reading, dividend discount or discounted dividend valuation, also called as dividend discount modeling, DDM. Correct? Everyone all set? So let's move to the reading number 2. They call it as discounted dividend valuation. I call it as DDM, dividend discount model. I'll just write down discounted dividend valuation. Okay. Bear with my handwriting. This is the topic where you will have abundance of formula, abundance of things to write. Again, most of the things are similar of what you did in your level 1. So there's no complicated thing out of it, right? Dividend valuation model, free cash flow based valuation model, and residual income model. All of those are based on a common thing that you're going to pull out the future expected dividend cash flow or residual income, bring it to the present using a DCF model, discounted cash flow model, derived by Professor John Bohr Williams in 1938. Right? The same model is used, only the components have changed. We use dividends, we use free cash flow, or we use residual income. The process, the technique is exactly the same. Are you with me? Understood? How many of you all consider this as one of their favorite topic or one of their worst topics? Let me know in the comment. Is this your favorite or worst? Favorite or worst? Favorite or worst? Favorite? Great. Great. Then I'm sure you'll love to do the timeline. Okay. Now, all of these formulas are interconnected. So let me go to the dividend valuation, dividend discount model. Okay. Yes. Initially, they have just introduced whether it's a what is a dividend discount approach, what is a free cash flow approach, which we are going to see later on also. I'll directly go to the part where we have one period dividend discount model, and then there is two period or multi-period dividend discount model, two period and multi-period dividend discount model. The important thing in all of this is that the price is generally available. So very basic, they call it as V0 or you can use P0. We are first going to use single period and multiple period dividend discount model. So in dividend discount model, when I use single period, okay, all I have to do is find V0, which is what I'm going to get in 1 year. I'm going to get next year dividend, that is D1, and next year price discounted with the cost of equity, which generally they call is called as R. I use here KE. Correct? Second, if it's a multi-period, if the approach is for the same approach is for multi-period dividend discount model, in multi-period dividend discount model, what is going to happen, guys? The DDM, I'm directly doing multi-period model. Multi-period model, we are going to use, let's say for 3 years. So we will have D1 plus D2 plus D3, and we will have the terminal value, which we call as P3, third year price. Price when you're going to sell the stock. It can be P3, P4, P5, anything. All of this, we are going to discount using our cost of equity. But since cost of equity is for different period, we are going to discount them from different period. Correct? You don't have to manually do all of this because all of this is provided to you in the cash flow function. All you have to do is use the cash flow function where you are going to use C01, C02, so on, and you will find the NPV. This is what we are going to do when it comes to the dividend discount valuation model using a 1 period or a 2 period model. Correct, everyone? Right? Now, all of these models were based on the concept that the price is available to you or the price is given to you. In case if the price is not given to us, then we will have to use the Gordon's growth approach where we are going to assume what will be the company's price at some point of time in the future. This is what I said. We are going to use a Gordon's growth approach. But again, the process is going to be same. We are going to pull out everything into the present using the Professor John Bohr Williams discounted cash flow approach. Unfortunately, this professor did not get Nobel Prize. I don't know why, because he was so remarkable in the technique, which is still relevant after 80 years. So there are basically these four approaches that we are going to use to find the present value of the company when the price is not available, right? Here we assume that the companies pay dividend or are able to forecast the future dividend, right? And they're going to consistently pay the dividend. In fact, these dividends are going to increase at a specific growth rate. That is why we call them as growth models. Growth models. Of this, the first and important growth model is Gordon's constant growth model. Then there is two stage and three stage, which is what we are aware. But the important thing which is new for us in level 2 is the H model. Correct? H model is where the transition won't happen immediately, but will happen over a period of time. So what we are going to do is that I'm going to highlight what are these four models. Gordon's growth model. This is your final component of a constant growth model. This is your constant growth model, number one, right? Constant growth model. Then there is two stage and three stage. I'll also highlight some important assumptions. We will directly move to where is a two stage and a three stage model. So if you look at two stage, three stage, they have in between giving PE based, but we don't require PE based models. So we will look at the two stage and three stage model where we will have the prices for dividend for multiple period, and then we will find the terminal value, and then we will understand the most important H model. H model has very high chance of being asked in exam because it's unique. It is something that was not there in your level 1. H model is where the transition happens not immediately, but it happens linearly over some period of time. This is where the H becomes very relevant. This is where the transition happens not immediately, but over a period of time. And then finally, you have a three-stage model. Which model is suitable for which company, I'll explain, and then I will write down the formulas. Correct? In between, there are several concepts which we will focus on. So what now we are going to do is that we are now going to move on to the different growth models, from the basic dividend discount models to growth models. So in the growth models, right, the first one that I'm going to focus on is constant growth model. Constant growth model, also called the Gordon's constant growth model. Okay, the important word here is constant. In constant growth model, V0 is based on next year's dividend over cost of equity minus G. Cost of equity, they use the reference as R. You can also use R. Correct? Very easy. Most of us are already aware about it. But what is the important assumption behind all of this? Let's focus on that. Let us highlight again what we have already focused on. First of all, the model assumes the company is going to pay the dividend in 1 year. This dividend will grow at a constant rate. This dividend will grow at a constant. That's why the model is called constant growth rate model, right? So it grows at a constant rate forever. So it's also called perpetual model. Also remember, the cost of equity should not be lesser than G, otherwise the price will be negative. So the cost of equity should always be greater than the growth rate. This is very important assumption. Got it, everyone? Right? Now, there are some important elements regarding to this, that this is just theoretical. In reality, it is unrealistic to assume that companies will grow forever at a high rate. We can assume that the companies can grow at the long-term growth rate of the economy, that is the long-term GDP growth rate, which is the nominal rate, which is, the long-term growth rate, a real growth rate plus inflation, right? So the GDP growth rate is what we can assume as a long-term growth rate. Remember, all of these are forecasts, so there is a high scope of error. Okay. So this is our constant growth model. Now in this, I can further go into discussion what is D1. D1 is D0 into 1 plus growth percentage, right? Cost of equity is using CAPM model is RF plus RM minus RF, that is risk premium into the beta, and growth, which is also called sustainable growth rate, is retention ratio into, yes, into ROE. Everyone with me? Correct? Also, How do I find dividend? Dividend, remember, sometimes they don't give you dividend. You can find it from earnings. So dividend per share is nothing but earnings per share into the payout ratio. So whatever earnings they give you into the payout ratio is your dividend. All of these are essential for your understanding of getting the components of Gordon's growth. Correct, everyone? Constant growth model. Anyone has any doubt here? Anyone? Check, 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 check. Right? Now, guys, two-stage or three-stage. The formula is no different here. Everyone? Anyone doubt? Okay, in two-stage or three-stage, again, assuming let's say 3-year period. So I will have D1 plus D2 plus D3 plus P3, same like before. P3, okay, assuming the company is going to, we are valuing the company for 3 years, and after 3 years, there is going to be a perpetual growth rate, constant growth rate. So now there are actually two growth rate. One is the short-term growth rate, GS, and then there is a long-term growth rate, which happens in the case of terminal value. But remember, all of this, again, we have to bring it to the present using the cash flow function. Now, the important thing is, what is this P3? P3 is what we call as the terminal value. Now, when I say P3, P3 is based on D4 over cost minus growth. And D4, what is D4? D4 is D3 into, watch out, 1 plus long-term growth rate over cost of equity minus which growth rate? Yes, the long-term growth rate. Are you with me, everyone, on this? The two-stage, three-stage? Correct. Check. Any rocket science here? Okay. So this is what we did in a single stage, in a two-stage. But when to use a single stage and two-stage, that is what I'm going to discuss with you, which is mentioned. And in between, they have actually put up a lot of other things like PEG and so many other things, which I will go in a flow. So first, we will focus on one stage, two stage, then the H model, and then we'll focus on those important things which they have put unnecessarily in between. I don't know why they put P and other stuff, which is anyways going to be repeated in the next topic, right? So first we are going to understand that when should we use these models? These models have to be used depending on where the company's situation or where the company lies. If the company is more like a startup, right? Then initially it will grow at a very high rate, correct? And then the growth will some point of time saturate. Finally, the company, that is called the transition phase. And then when the company becomes a large cap, it is going to mature and grow at a constant rate. For example, let's say the initial high growth rate, the short-term growth rate, let's say is 20% for first 5 years. Then the growth rate in the transition phase, let's say, is going to be 10%. Finally, the company, after 2 more years, 3 more years, or 4 more years, the company is going to saturate and grow at a constant rate. That is the long-term growth rate of, let's say, 5%. These are the phases. Now, a company which is a startup company will actually pass through all these three stages. So, multi-stage model or a three-stage model is generally used for a startup company, right? But company which is going to be going through a transition, for example, it is right now growing at a high rate, but then it will saturate, right? These companies whose ROE is approaching the cost, it is moving towards it is right now growing at a high rate, but then it is going to grow at a slow rate. So that's a two-stage model generally these companies use. Companies which are mature, they grow at a constant rate where the ROE is already at R. So these companies use a stable or a constant growth rate model. Got it, everyone? Right? What we saw is a constant growth rate formula, and we also saw the two-stage and three-stage where the formula is the same. In reality, we are actually also use spreadsheet modeling in real life, although we are not going to use in the syllabus any spreadsheet modeling. Correct? Important thing, what is the new model called the H model? Two-stage, three-stage is fine, but the H model has a slightly unique formula. So, where is H model here? In the syllabus, they have given here the H model. Why is the word H? Because the company is going to transition over a period rather than suddenly falling. Correct? So in fact, we have some questions where they have described how to perhaps use the H model, where they have used the transition. So this is a two-stage model, which we have already used, where the company is initially growing at a high rate and then low rate, right? You don't have to memorize all this formula, but I would want certainly your attention to be on the H model, this formula, and the word H is the transition phase, which is actually averaged out as half of the difference between the high growth and the low growth phase, right? That is a transition phase. It's averaged out. What about this transition phase and how to apply that in the formula? That is what we are going to see in the formulation. So H model is having a very unique formula. Let us understand the formula for H model, two stage, three stage, right? I'm now going to use the H model valuation. Now, actually, the original formula divides the valuation into two parts. So our V0 is based on D0 into 1 plus growth over R minus G, or cost of equity minus the growth rate. Now, which growth rate is this? This is actually the long-term sustainable growth rate. This is the long-term growth rate. But along with this, we are also going to use the valuation of the transition phase. Yes, so this transition phase is basically based on the dividend which is going to be there currently, and the transition period. Transition period, which we will get to know what is the transition period, everyone. So the transition period is called H. H. H is nothing but the transition phase divided by 2. So that H into the difference between the short-term and long-term growth rate. Short-term and long-term growth rate. Again, all of this divided by cost of equity minus the long-term growth rate. Remember, in the discounting, whenever it is going to be perpetual, we always use the long-term growth rate. We always prefer to use the long-term growth rate. Everyone with me? Correct? Check, check, check. Right. Now, it does depend when you are calculating the H model. Sometimes you calculate the H model where the transition is happening now. In some cases, the transition happens after 2 or 3 years. So at that time, you will have to use the H model. Okay. Now, you can actually combine this formula, and you can use this formula rather, where we can combine both the stuff about the H model. We can, if you notice here, the D0, and along with D0, what is common here? Along with D0, the denominator is common. So what we can do is that we can use the denominator and the D0 together and can compress the valuation model. Yes. Anyone can help me? What is going to be common here? D0 over cost of equity minus long-term growth rate is common. Correct? Correct. Multiplied with what will be left here? 1 plus growth rate in the first part. Correct? Yes. What about the second part? Plus, plus. Yes. What is going to be left in the second part? In the second part, it will be H into, yes, H into, because D0 and KE over GL is common. So H into your short-term and long-term growth rates, right? The difference between your short-term and long-term growth rate, right? This way you can compress the formula also. Everyone with me, right? You can use either of them, doesn't matter. This H model, I expect it to highly come up in exam. So you can combine these both. You can combine that, you can do the D0 key cost of equity minus long-term growth. You can pull out this as common, and the remaining balance will be remained, correct? Remember, H is the transition period divided by the length between the difference of the short term and long term, divided by 2 to just take out an average. High chance of H model being asked in exam. Clear? Right, everyone? Okay. Now, in between, if you notice, along with the H model, they've given few things, right? These are some of the things which are going to be repeated in the next topic, like the PE based, that I'm not putting right now. We'll rather do it when we do the comparables model, because they have actually repeated this in this topic also. All the multiplier models are repeated in this topic also, in the next topic also, right? So all this PE based, leading P, trailing P, all of this justified P. You don't have to worry about them right now. You can do it later as well. However, there is something related the PEG model, price at reasonable growth, which is also done later on. But I would suggest let's write it down, even if we have to write it down twice. So the PEG model, where is the PEG model? PEG model, yes. PEG model, and then present value of growth opportunities. Yes. This is again related to comparable, so it is going to be asked there. However, I would suggest we write down this formula here. So where we are going to value the company based on the additional benefit of retaining. Remember, companies, if they pay out all their earnings, there is no future growth, isn't it? So what is this PVGO? PVGO is the additional benefit if the company retains. So this is the present value of growth opportunities, that is PVGO. So I'm writing what is PVGO, present value of growth opportunities model, where the value of the company is based on earnings yield. What is earnings yield? Earnings over price, correct? That is earnings yield. But here I am going to use perpetual earnings. I'm going to assume that earnings are going to be received forever. So the model is based on two components. One is earnings over the cost of equity. What does this first part refer? The first part basically gives us the perpetual value, of the cash flow, whatever earnings company is going to earn forever. We are assuming the company is going to get these earnings forever. Now, if the company is going to get these earnings forever, right? That's enough, right, for the company? Yes, but it does matter whether the company is going to retain these earnings or payout. The company will only grow, or company will have additional value if it is going to retain these earnings. That's your PVGO. Now, many students ask questions, sir, how do I find PVGO? Actually, PVGO is the missing number. Based on the price of the company and the earnings and cost of equity, we are going to find out the PVGO. So even though the formula actually tells you what is going to be the intrinsic value, we are going to assume that the intrinsic value is the same as market price, and we are going to recalculate to find the PVGO. Remember, PVGO is the advantage that, or the valuation that the company has because the company is retaining and not paying out the dividends. That's your PVGO. Clear, everyone? Right? Right? Anyone? Any questions? Correct? Correct. Okay. Similarly, we are going to use the valuation for a company which is going to pay preferred shares. Value for preferred share is same as Gordon's growth. The only thing is that the preferred dividends are constant. So there is no growth. So in fact, if you look at the value here is D, what is the normal valuation model? D0 into 1 plus growth over cost of equity minus G. Here there is only D0 and cost of equity. There is no growth, neither in the numerator nor the denominator, because the the preferred shares dividend is constant forever. So when they ask me to find the value of the preferred share, it's very easy. All I'm going to do is that value of preferred shares, all I need is the dividend, preferred dividend. We are going to use the preferred dividend here. Perpetual preferred shares, okay? Preferred dividend divided by the cost of preferred share. Instead of cost of equity, we are going to use the cost of preferred share. Very easy, correct? This is how I will use the preferred dividend divided by the cost, or yes, the cost of preferred equity. Clear? Both will be provided. You can find the price. Sometimes the preferred dividend price is given, so you can find the cost. You can just reverse calculate each of them. Got it, everyone? Clear, clear, clear. Here it has been mentioned when is this model Gordon's growth rate applicable. They've given us the strength and the weakness. It is applicable. These are the strengths. These are the weakness of the models. Highlight very important thing about the strengths, that these are models used for companies which are going to be stable and going to pay dividends, right? But they are also used to value the indexes, correct? Which is going to be a benchmark. It's very easily communicatable, and all of these are important elements, right? But there are some weaknesses that you should know about the Gordon's growth. And the biggest weakness is it's very sensitive to the estimate because everything is forecasted, right? And it cannot be used for non-dividend paying companies. That's why we are going to use the free cash flow based models. These are some of the weaknesses of the valuation model that needs to be highlighted. Remember, all of this eventually has to turn out into an intrinsic value using the dividend discount approach. You will be given all the discount, all the dividends or base dividend, and using that base dividend, whichever approach is suitable, you can find the value of the company. There is no complication generally asked by the CFA Institute in this. They keep it pretty much straightforward. Remember here that if sometimes they ask you what is the cost of equity or growth rate, considering the price is fair, in that case, when we do the reverse calculation, that is called implied growth rate or implied cost of equity. For example, in a two-stage model, if the price is already given to us and if they ask us what is the implied cost of equity, what we will do when we do the case studies, I will show you, we will do what? We'll do trial and error. Through trial and error, we'll get the cost of equity or the growth rate, whichever they ask. Perfect, everyone, right? Here, one of the ratio, which is the growth rate, which is retention into ROE. In case of ROE, sometimes they use the DuPont model. Everyone aware about the DuPont model? What is the DuPont model of ROE? Very easy. ROE, it's a DuPont. ROE, by the way, is net income over average equity or total equity, depending on what information they give you, right? Either you can use average or total. Now, this ROE can be split into 3, 4, 5 parts. Okay. Again, similar to what you did in level 1, no brainer here, but still ROE can be divided into 3 parts. First part can be net income over sales over total assets, and total assets over total equity. If you multiply all three, eventually you'll get net income over total equity only. Net income over sales. What is this called as? Everyone in the class? Net income over sales. This is called your net margin, asset turnover, and financial leverage. So net profit margin, asset turnover ratio, and financial leverage. Got it? Further, you can break down net income over sales into different other components also. You can break them into tax burden, interest burden, and operating margin. So you can do that as well. And that will become a 5-point ROE. Hopefully, they will ask you a 3-point ROE, which is more than enough, right? 5-point ROE, you can just split the net income over sales into 3 more components. This ROE and the retention ratio together gives you the sustainable growth rate, which we discussed already here. That is going to be your sustainable growth rate. Everything with me? Check, check, check. Correct. Let's see. We have covered all the important elements here. Guys, in this topic, unfortunately, they've given you the PE-based models. I'm not coming up to those PE-based models because we are going to redo them again. Correct? Two-stage H model valuation we will do when we see the case study. That is very essential. Two-stage, three-stage. This is where your calculation skills are very important. Correct? These calculation skills are going to be the same when we do the free cash flow based models. Now, in reality, we are going to use spreadsheet model in real life. However, we don't do that in the exam point of view. So even though practically we are going to use a spreadsheet model where we can use any assumption, we can, probably use valuation for 4, 5, 10 years. Spreadsheet modeling is very important. They've given you the steps of spreadsheet modeling. You don't have to memorize those steps. You can just go through them again. No need to memorize all of these steps. It's the same steps that you do manually, just that in spreadsheets the biggest advantage is that you can probably use any pattern of cash flows. You can use any assumption. So the biggest thing here is that flexibility and computational accuracy of the model. And what we can also use, they have probably mentioned using a spreadsheet, accommodate nearly any pattern that the analyst can imagine. So this is what the spreadsheet model is, where you can accommodate any of the pattern that you feel like. Got it, everyone? All right. Otherwise, the topic is easy. all the questions we can derive. They've used sustainable growth rate using ROE and so on, right? Eventually, whatever the intrinsic value that you get, you are going to compare with the market value and then make up your decision whether the stock is under overvalued or correctly priced, right? Without that decision, the situation is incomplete. Got it, everyone? Clear, 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 right? Now we move to the topic of free cash flow. But by the way, let me just remind you, we are doing the formulas. I hope you all are writing with me. If not, no problem. These formulas for relevant topic, I hope I'm not missing out on anything. If you feel anything is missed out, just point out that to me. Correct? Now we'll move to the third reading, which is so important, which is perhaps the if you ask me that majority of the questions are going to be asked from which reading, we are going to get most of the questions from the reading of free cash flow. Free cash flow is something that you had very little component that in level one, but in level two, free cash flow, and in real life also, you're going to value all the companies using free cash flow approach, right? So reading three, free cash flow valuation. Got it? Yes. Now, in free cash flow based valuation, as I said, the technique is the same, but here it is important that whether we are aware how to calculate free cash flow from different angles. Remember, there are two free cash flows here. One is the free cash flow to the firm, which is for debt and equity both, correct? And then there is free cash flow to equity, which is FCFE, only to the equity shareholders, assuming the debt holders are paid. Correct? Both of this are can be derived from the same thing, or they can be usually derived separately as well. But actually, it comes from the same tree. That's why you had an amazing explanation given to them, given to us by them in the form of how the same component can be used to derive FCFF or FCFE. I'm going to go into the different versions of calculating FCFF and FCFE, which will eventually give us the value of the firm or the value of the equity directly. Just for your reference, from the cash revenues, we are going to see revenues, we are going to subtract all the costs, all the cash operating expenses, correct? But from that, we will also subtract something that we might require for the future reinvestment into the company. And we reinvest into working capital, which we require regularly, and fixed capital, which is CapEx. So not only we deduct the cash expenses, but also the provisions for reinvestment, that is fixed and working capital. That's what we call as free cash flow. Now, this cash flow is available, generally free cash flow for the entire firm. When I say firm, as I said, it's debt and equity. But from this, when who gets a priority of payment? The debt holders. So from this, when the debt holders are repaid, what is left is called FCFE. And what do we pay to the debt holders? We pay them interest, anything due, and also repayment of principal, which is generally adjusted in something that is what we call as net borrowings. Don't get worried about the formula. I will go into the formula in a moment. This is going to be my FCFE. So from FCFF to FCFE, the debt goes out. FCFF is used to value the firm, where the discounting rate is weighted average cost of capital, but FCFE is used to value the equity, where the discounting rate is cost of equity, our capital, very own. Correct? All of this will eventually give us the value of the firm. From that, we can derive the value of equity also. So there are two ways to derive the value of firm. Assuming it's a single stage, you can do multi-stage in the same manner that you did in the dividend discount model. Now I will derive that how to find the value of firm and how to find the value of equity. Okay. For value of firm, you require FCFF. FCFF for the next year. Okay. but we discount with WACC minus the growth rate. Remember why WACC? Because WACC is the cost of capital for the entire firm, for debt and equity. But when it comes to value of equity directly, you can do it from FCFE next year, but cost of equity minus growth rate. Am I correct? Everyone check, 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 right? Now, value of firm is the value of the entire company, but in reality, value of firm is value of debt plus value of equity. If there is preferred, you can use value of preferred also. So it's a combined valuation of the entire company, debt, preferred, and everything. That's going to be your value of the entire firm. Now, from this firm valuation, what you can do is that you can pull out the debt, and what you get is the value of equity. So both ways are possible. So value of firm you can assume is market value of debt and equity. For a reference, we will go into the detailed component of it. From this, in reality, we also subtract for cash. So cash and equivalents, right? That is going to be my value of firm. And from this also, I can derive the value of equity. So now if I have to recalculate the value of equity, it is value of firm minus the market value of debt and plus cash and equivalents. These are the two ways to derive value of equity, which from which we can derive our intrinsic value. Remember, whenever you get value of equity, you divide it by the number of shares, correct? You divide them by the number of shares outstanding, divide them by number of shares outstanding. This is how you can get your intrinsic value of the company, but using the free cash flow approach. So you can derive that either using the FCFF approach or the FCFE approach. Ideally, they both should give you the same answer, but in reality, there is some differences due to the accounting, which you will see over the process. Got it? This is going to be our core reason of doing this particular topic. That is, again, our focus is valuing the asset. That is intrinsic value. Correct? So this is what we are going to use. Again, most of the things are repeated here. Very important is the firm's value is discounted using FCFF at WACC, and FCFE is done to value the equity, but the discounting rate is cost of equity. Right? Correct? Now, this approach is in contradiction to the dividend discount model approach. But before I show you the dividend discount model approach, let me also tell you there are some things which are not relevant here, which you can openly skip. And I had told you when we were doing the full course is that there is this concept of adjusted present value approach, which is just for your knowledge. You can probably not go in detail of it. You can just simply skip, right? But we are going to focus on FCFF and FCFE only. But before that, we need to understand that how come it is different and when should I use which model? When should I use the dividend discount model and when should I use the free cash flow model? This is perhaps the most important thing. Whenever there is an ownership perspective, in that case, if you're going to be the major or controlling stakeholder, basically you are going to be the acquirer of the company. So the dividend policy is in your control. So you can tweak or change the dividend policy. So the past dividend policy of the company is no more relevant for the future. In this case, we use the free cash flow approach. Yes. So we use the free cash flow approach when we can change the dividend policy, which is the control perspective. Under this case, we use the free cash flow approach. However, if you're valuing the company from a minority stake where you're going to buy some of the shares of the company, in those cases, you can use the dividend discount model. So from the minority's point of view, you can use the dividend discount approach. Remember dividend discount approach or dividend discount model from a minority point of view, and from the controlling point of view, the free cash flow approach. Correct? Everyone? Right? They have given us the reason that why does the analyst prefer to use free cash flow instead of dividend discount model? Because not all companies pay dividend. Long gone are those days when all companies used to pay dividend. Today, no, there's no compulsion on equity dividend, right? So it is at the discretion of the board. And if you remember during my lectures, I've also discussed that how Apple companies currently it's paying dividend, but in the past there have been 17, 18 years where Apple did not pay dividend. correct? So it may be consequently, it may consequently be poor aligned with the firm's long-term profitability. So dividend paying is not something considered as a positive sign by the company, because the company thinks we might require this capital for future. So there's no point of distributing the dividends. Correct? Also, as I said, from the controlling stake, if the company is viewed as an acquisition target, then free cash flow is more appropriate. And free cash flow is more related to long-term profitability compared to dividend, because this is more sustainable. Okay. See, remember, free cash flow is the capacity of the company to pay dividends, whether they pay or not. Got it? Now we are going to use different approach to calculate FCFF. Well, there are various formulas that I will highlight here and I will write them, because all of them together are just going to give us the FCFF only. So if you have noticed in the syllabus, we are going to use FCFF using net income approach. Correct? They have discussed in detail how to calculate fixed capital investment, non-cash charges, all of those, which you don't have to go in detail right now. So first is the net income approach, right? Then you have different approaches in the free cash flow calculation itself. So then we are going to use the other approaches after net income. We are going to use different approaches, including the EBIT approach. And then there is operating cash flow or CFO approach also. So there is CFO based approach, there is EBITDA based approach to derive FCFF. So FCFF has more than one types of way through which you can derive FCFF. All of these approaches we will see: net income, operating profit, EBITDA, and operating cash flow. One, two, where is it? Two, EBIT. Then the third one is using the EBITDA. And the fourth one is operating cash flow. Four ways of deriving FCFF. FCFE, there is actually 3 to 4 ways of deriving FCFE also. So I will highlight those ways through which we can derive FCFE. First, you can derive FCFE from the FCFF itself. So this is your first approach, deriving FCFE from FCFF. Then you can also use net income and operating cash flow. So you can also derive using net income, operating cash flow. These two also you can use. Correct. Then we will do the discussion of preferred capital. Assuming right now we are assuming there is no preferred shareholders. However, there is one more approach of deriving FCFE, is when we are given something called the target debt ratio. That is the fourth approach. So fourth approach of FCFE, when they have given us the target debt ratio, yes. So four approaches of FCFF, four approaches of FCFE. All of these formulas I'm going to write down here. You can join me and let me know how to derive the formula. While doing the formula, I'm also going to tell you that FCFF is for the entire firm. It basically tells us what is the cash flow available for the debt and equity both. Okay. So first we will use the net income approach. Then we will use the EBIT approach or operating profit approach. Then I will use the EBITDA approach. And then I will use the operating cash flow approach. All of the four approaches basically to find the FCFF. Okay, eventually all of them are going to give me FCFF. So net income, yes, net income, everyone, plus the non-cash charges minus the working capital. This is actually your operating cash flow. Net income plus non-cash minus working capital. This is your operating cash flow. So when I use the CFO, I can combine all of this as CFO, net income plus non-cash minus working capital, right? But two more adjustments are needed when I use the net income approach. I need to deduct for fixed capital investments also, that is CAPEX, because after that, what is remaining is my free cash flow. But free cash flow for the entire firm, when I do the net income, tell me one thing, when I do the net income, have I already subtracted for interest or not? I've subtracted for interest, am I correct? But I'm calculating free cash flow for the firm. So interest which was subtracted for the debt holders need to be added back. Therefore, we add back the interest, and you all know whenever we add back the interest, we always add it 1 minus t because interest is paid after tax. Interest has a tax benefit, right? Clear, everyone? So we add back the interest 1 minus t. This is what we use when we use the net income approach. Now in this, when I combine the net income, non-cash, that is depreciation, amortization, impairment, all of these are non-cash, which are added back. And I subtract the working capital. These three together are CFO, operating cash flow. So what else remains? The only thing then remains is fixed capital investment and interest 1 minus t, isn't it? If you notice the similarity out here, everyone in the class, if you notice, these three are nothing but these three are your operating cash flow. Check, 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 everyone. Clear? Got it? Yes. When I use the EBIT approach, EBIT, earnings before interest and tax, and from this, when I subtract the tax rate, this actually replaces net income and interest 1 minus t. Yes. So it actually replaces net income on one end and interest 1 minus t, because if you add net income and interest 1 minus t, it translates into EBIT 1 minus t. So what else is left? That is what we will write, plus non-cash charges, that is depreciation, minus the working capital and fixed capital. So minus the working capital investments and minus the fixed capital that is left. So basically, when I combine net income and interest 1 minus t, I get EBIT 1 minus t. That's my EBIT approach. You can use any angle. Eventually, you'll get the same FCFF. But when I do EBITDA, along with EBIT, I am also not deducting the depreciation and amortization. That is a non-cash. So even the non-cash will be missing when I use the EBITDA approach. EBITDA. Why? Because in EBITDA, the DA stands for non-cash. So when I do EBITDA into 1 minus t, I no more need to add the non-cash because I've not deducted the non-cash. But remember, non-cash has an advantage that you will not deduct for sure, but because of having depreciation, there is no cash outflow, but there is a tax benefit which you need to add. So what we do is that we add the depreciation into the tax. This is very crucial. So of course we haven't deducted the depreciation and amortization, but because of that, there is a tax benefit which we need to add. Rest all remains the same. So minus working capital and minus fixed capital. Now you would wonder, where is interest 1 minus t, guys? When it is EBITDA, I have not deducted the interest, isn't it? So there's no need of adding it. Only when there is net income, I deducted the interest, so I added it back. If there is EBIT and EBITDA, I haven't deducted it, so there's no need to add back. Everyone with me on these 4 approaches of FCFF? Check, 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 check. Confirm, confirm, confirm. There are only 4 approaches, no 5th approach. Now we will use the different approaches of FCFE. Remember here, I'm just summarizing all of them, which is scattered across the topic. Actually, you don't have to worry. The topic is so compressed, but when you do it first time, it's so much scattered. Actually, you can summarize the entire topic in this one page. FCFE is free cash flow to the equity after the debt has been paid. So first, we will use the FCFF approach. Sorry. FCFF approach to finding the FCFF. Sorry. My handwriting are going more and more brilliant day by day. So first we will use the FCFF approach, correct? The second, we will use the net income approach. Third, we will use the operating cash flow approach, again for the same thing. And the last, where we will use the target debt ratio. What is target debt ratio? When they give us target debt ratio, what should we do? This is very crucial. I expect this to be asked in exam. So first we will use FCFF, net income, this. Remember, all of this are going to be FCFE. Eventually, they're going to give me FCFE. So from the FCFF, Who's going out? The debt is going out. So what was supposed to be paid to the debt, we need to deduct that. We are going to pay them interest. So we will deduct the interest 1 minus T from the FCFF because debt is going out. Remember from FCFF, when we go to FCFE, the debt goes out. So pay them their interest and also adjust their principal. But the principal adjustment is what we call as net borrowing. And remember, net borrowing is actually borrowing minus repayment. It is borrowing minus repayment. So remember, if the borrowing is more, the answer will be plus because that will be added to the cash flow. But if the repayment is more, the answer will be negative because it's going to be cash outflow. Understood, everyone? Clear, 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 clear. Perfect. Now, using the net income approach. Remember the net income that we use for FCFF, net income plus non-cash minus working capital. Well, that's going to be there. Net income plus non-cash minus working capital investment, that's going to be there. In fact, we are also going to deduct the fixed capital investment. So there's no harm. Fixed capital investment is also deducted, but in the FCFF, we added the interest 1 minus T. Now we no more need to add the interest 1 minus T. So neither are we deducting nor are we adding. So what is the conclusion? In reality, see what we did is net income plus non-cash minus working and minus fixed capital. Now net income, in net income, we've already deducted the interest 1 minus T. So again, we don't need to, neither we need to add nor we need to deduct because it's already adjusted in the net income. All we have to do is simply add the net borrowing. That's it. Understood this? And of this, when I combine these three, it becomes my CFO. So my CFO minus fixed capital investment plus I will do the net borrowings. Understood, everyone? Check, 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 check. However, if they give me target debt ratio, then very interesting thing, my formula is net income minus fixed capital minus depreciation minus working capital investment. However, not entire fixed and working capital is deducted from the net income. It is adjusted for the debt ratio. So 1 minus debt ratio, 1 minus debt ratio, 1 minus debt ratio, by the way, is equity ratio. So not entire fixed capital and depreciation is deducted to find the free cash flow because some of that burden is going to be taken by the debt. So only the remaining 1 minus debt ratio is, by the way, equity ratio. 1 minus debt ratio is equity ratio. Okay. And basically debt ratio, I will also write down debt ratio is debt over total assets, or you can simply write debt over total asset is total equity plus total debt. So it basically tells you the proportion of debt in the capital. Got it, everyone? Check, 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 check. And 1 minus debt ratio is equity ratio. Perfect, everyone, everyone. Right, right. This is how I can basically all the components of FCFF and FCFE I've derived in the same page. Whatever the components they have throughout the syllabus, all of that on the single page. Correct, correct, correct. Now there are some additional things that they've actually done a deeper analysis, but I don't want you all to go in that deep of how exactly there are adjustments in fixed capital, working capital, what all those adjustments are. That you can read it or you can rely on your knowledge. Also, they've given the difference of what is almost FCFF and actual FCFF. The only difference is that in actual FCFF, we do deduct interest 1 minus T. In almost FCFF, we don't do that. This is just for your general knowledge. This is not something that they're going to test in exam. So my suggestion is, this is just, you need to know that the only difference between both is due to interest 1 minus T. We deducted when we calculate the actual FCFF. But that's not the case when we do almost FCFF. So that is one thing. You don't have to memorize all of this thing. Correct, 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 correct. Right? What else? What else? What else is that is missing here? Okay, yes. Now remember, while doing this entire stuff, we did not discuss about preferred dividends. But if there was a preferred share, the treatment is almost the same. There is only, so assume the treatment of preferred share is same like interest and debt. But the only thing is that preferred shares are paid from after tax amount. So there's no need of tax adjustment. So whenever we are calculating FCFF and FCFE, and in rare case, if they use preferred shares also, then free cash flow to the firm, in that the net income is not deducted from the net income. We haven't deducted the preferred dividend. So there's no need to add it. If it is deducted, then you will have to add it. So when we are going to calculate FCFF or FCFE, remember to treat preferred stock same like debt. The only thing is that it is not tax deductible. So there's no need of interest 1 minus T. Otherwise, the treatment is same. Got it? And one more thing will change is that your WACC will now have weight of debt, preferred also, and equity. That's the only thing. Just remember the treatment is same. It's just that the interest 1 minus T, here it is only dividend, preferred dividend. No need of interest 1 minus T, or no need of 1 minus T. Correct? Rarely they do put preferred dividend in the case, but in case if they put, this is the very easy approach. Now, once you derive the FCFF and FCFE, then you have to utilize the same in a single stage, multi-stage, Gordon's growth. The process is going to be the same. There's no difference in the process of deriving the future valuation of the company. Correct? Uses of FCFF and uses of FCFE. Remember, FCFF is for debt and equity both, but FCFE is only for equity shareholders. Correct? And where was this formula? Yes, debt ratio, target debt ratio. This is what the company's long-term debt ratio is, which you can get from the management and so on. Just one thing I would like to highlight here is that here the FCFF and FCFE almost should give you the same answer, correct? But that's not practically always possible, right? So we are going to use FCFF and FCFE in real life, but there might be some differences. These differences can be due to various reasons. Clear? So practically the analyst might calculate both separately. However, if there is any knowledge of the future expected, company is going to do capex and so on, so accordingly you will have to adjust the target debt ratio, which is very, very practical, which basically tells you that how much of the capital which you're going to reinvest into fixed and working capital, how much of that is going to be funded by debt. So the remaining only is a burden on the equity. So when I use 1 minus debt ratio, it is actually equity ratio. So not the entire capex or working capital is funded by equity. The other part is funded by debt. Also, if you carefully notice the formula, if there is no debt, then the ratio will become 1. Means entire fixed and working capital will be funded by the equity shareholders if there is no debt. Understood, everyone? Check, check, check. Correct. Some important elements that whether you're going to fund the company with debt or equity, does that have any impact on the cash flows, free cash flow? So your financing decision, does it have any impact on the company's calculation of FCFF and FCFE? Very, very important. Very first, financing decision has almost no impact except we will now see where exactly the impact is. So effect of financing decisions on free cash flow. Is there an effect on dividend, share repurchase and share issue? Why is there no effect on FCFF or FCFE? Because these are the cash flows available for debt and equity. So from the final amount that is left, from that you're going to pay the dividends or any adjustment of share is after everyone is paid, after the debt and preferred are paid. So any changes, any financing decisions, whether the decision to give dividends or not, whether to repurchase the shares or whether to issue more shares, they have no effect on FCFF and FCFE. However, what about leverage? Leverage. FCFF is for the entire firm. So leverage does not affect because it considers debt also. But FCFE is the cash flow available to equity after the debt is repaid. Now, after the debt is repaid, so it will have an effect on the FCFE. But will this effect be short term and long term? Let us understand. So, short term and long term effects partially offset in the sense means, see, remember that whenever there is a debt issued, okay, suppose if the debt is issued, right now there is a cash inflow because we add net borrowings, but later on, because of high interest, there will be a cash outflow. Similarly, if the debt is repaid, right now there is a cash outflow, but later on in the next years, the interest burden will be less. So it simultaneously offsets each other. Therefore, the short term and long term effect nullifies or sets off the effect on FCFE, but there is a minor effect on FCFE. Compared to that, FCFF is foolproof. So if you're actually trying to value two companies which have significant difference in capital structure, FCFF is preferred, not FCFE. So valuing the company using FCFF is preferred. Understood, everyone? Clear, clear, clear. Got it? Also, we've already confirmed that free cash flow approach is from the control perspective, whether the dividend and the dividend discount model is from the minority's point of view. Got it? Right? Some of the discussion that they've done is that since we are using all these accounting information to calculate the free cash flow, most of these cash flows are subject to manipulation, especially anything which is related to accounting. That is, the net income is a poor proxy, even EBITDA or EBIT is a poor proxy because these are accounting numbers. So actually the cash flow approach or CFO approach is more suitable. All of these are forecasts, so you have to do sensitivity analysis because any change in any of the variable will have a significant difference in the valuation. So sensitivity analysis is very important because there is a chance of error in the valuation. Definitely valuation, you're going to forecast the future FCFF and FCFE. So there is a high chance that the growth rate, multiple growth rate that you might use, they might not be suitable to the industry or to the company. So there is one chance of error that your growth rate assumption is wrong. Correct. Second, they are saying that things can go wrong. The chosen base year for FCFF growth rate and forecast, that can also be the wrong. If you're choosing a particular year when the valuations are already too high compared to when the valuations are too low, then your results will be completely different. So which base year you use and what is your assumption of the growth rate, they have a significant impact on the valuation of FCFF and FCF. Got it? Right? One more thing I would like to highlight here, they have given you the single stage value of the firm, which we've already covered. Here, remember when you're doing the WACC calculation, these weights are based on market values. Yes. So whenever I'm going to do the WACC calculation here, right, my WACC, which is weight of debt into after tax cost of debt plus weight of equity into cost of equity. Remember, these weights are based on market values, market value of debt and equity. That is very important for you all to consider whenever you're going to calculate the weights, right? Rest of the thing, they have just done the calculation throughout the syllabus where you will also have to forecast the FCFF, FCFE and do the calculation. One more important thing is that whenever you're going to find the terminal value you can find, for example, if you're trying to find P4, you will use D5 or FCFF5 or FCFE5, next year's free cash flow or dividend, right? The assumption is the same, just that instead of always using the Gordon's growth approach, you can also use the P-based approach, which you will learn in detail. And they have also mentioned that you can use the relative valuation approach to find the terminal value. Terminal value is the last year value, which either you can find using the constant growth rate model or you can find using the PE based approach. PE based approach. This we are going to learn in more detail. This is for the last year, the terminal year. Just remember one thing, if you're using a trailing PE, you use the current year earnings. If you are going to use the future PE, for the leading PE, you will have to use the next year earnings. Understood this part? Everyone? Clear, clear, clear. So all of the formulas needed for your free cash flow are covered here. This is first you're going to get your value of the firm, correct? WAC formula, FCFF, different approaches of FCFF and FCFE mentioned. There is no other approach beyond this, correct? Now this topic sounds so lengthy, but in reality it is easier because all of that combined here, you don't have to deviate anything beyond this. Just do this part. Is that clear, everyone? FCFF, FCFE? Check, check, check. Just remember the treatment of preferred share is same as debt. Just that there is no interest 1 minus T. But in exam, the questions are slightly time consuming sometimes when they want you to predict the future FCFF and FCFE. Otherwise, the questions are not so lengthy. Got it, everyone? Yes. Now let's move to the relative valuation based approach, which is also called market based valuation or P based or EV EBITDA based valuation approach. I use the reference here. This is going to be a reading number 4. Okay, I don't care about what actual reading number is. This is market based valuation approach, market based valuation approach, or I call relative valuation. Okay. Here, majorly our focus is going to be P, price sales, price to book value, and of course, EV beta. Correct? So this is called comparables, methods of comparables. But within this comparables, there are two forms of comparables and method of forecasted fundamentals, slightly different. Remember, they are based on the concept of law of one price. Means if the valuation of the industry or the company peers is this, how come the actual company's valuation is more high or more low? It should be at par with the industry or peers. If not, then it is called undervalued or overvalued, right? So we are going to compare similar assets price in the market, or and accordingly we'll decide whether our stock is relatively under or overvalued, right? This is called your method of comparables, where we are going to find out the average price of similar or identical companies. But when I say method of forecasted fundamental, this is where we are going to use the justified valuation. The valuation not based on actual price, but based on our Gordon's growth or intrinsic valuation. So what price do you use? That defines whether it is method of comparables or method of forecasted fundamentals. Forecasted fundamental is what we call as the justified PE ratios. Okay, justified are based on fundamentals. So method of, we are going to say method of comparables, methods of comparables, comparables and forecasted fundamentals. I'm using the same things which is there in your notes. So I'm not writing anything which you probably are not aware. It's in your notes as well. So methods of forecasted fundamentals and methods of comparables. When I say method of comparables, assuming the law of one price, we are comparing our company's price with the market multiple and comparing whether it is under or overvalued. So in method of comparables, the price that I use is the average price of the industry. This is what we use. So this is what the actual relative valuation approach is, where we are going to use the prices of the actual prices of the other companies, compare it with our price. So the price is the differentiator that we are going to use here. In the method of comparables, in the method of comparable, we are going to use the actual price. In the method of forecasted fundamentals, what we are going to use is that we are going to use the justified price or the intrinsic value that we have done. Correct? So here we are going to use the actual price, and here we are going to use the intrinsic value, correct? Which is based on the Gordon's growth, right? Okay. Now remember the PE ratio, which is the highlight of this topic, is price over earnings, correct? So my PE ratio, which is market price per share over earnings per share. This is your PE ratio, but this PE ratio, whether it is trailing or leading, trailing or leading, trailing PE ratio and leading PE ratio. What is the difference in trailing and leading? It is about the earnings. So when I use price is going to be common under both the case, but the difference is related to earnings. Here I will use in trailing means past. So I will use EPS of, let's say, last 12 months. So we use EPS of previous 12 months. Okay, this is what we use in the last year EPS or E0, I can say. But when I say leading PE, we use the forecasted earnings. So EPS of forecasted 12 months. Forecasted 12 months, which is basically nothing, but this is your E0 and this is what you can say as E1, next year earnings. So this is your P0, current price divided by next year's earnings is your leading PE ratio. Everyone with me? Check. Correct. Tell me one thing, which earnings will be higher? Current year earnings or next year earnings will be higher? Next year's earnings will be higher, isn't it? Check. Next year's earnings will be higher. Since next year earnings are going to be higher, the leading PE ratio will always be smaller than the trailing PE ratio. Am I correct? So the conclusion is that the trailing PE ratio will be greater than or less than the leading PE ratio. It will always be greater because the future earnings are going to be higher. Everyone with me on this? Check. Confirm. Okay. Yes. Now, this is what we are going to go and understand throughout the syllabus. This is method of forecasted fundamentals. Here, the important thing is the justified price multiple, where, as I said, this is based on fundamental, where the price is based on the Gordon's growth. So here, the justified PE ratio is very important. Remember the conclusion of PE ratio or price with the market price or market P ratio is just the same. That if your P ratio or price is lower than the industry or peers, then it is undervalued or otherwise it is overvalued. Correct, right? Okay, right. Some of the important rationales for using the PE ratio is because earning is very famous. Most of the people invest in the company looking at the earnings or the profitability, right? It's very popular and easy to use. There's no a lot of information required. And historically, it has been proven that long-term returns are based on the PE ratio. Problem is that what if the earnings are negative? Then the P ratio is not reliable, and earnings are done by the management. So there is a management discretion in terms of earnings. Also, the volatility of the ratios make it very difficult for analysis because the P ratios are differently interpreted, they are cyclical, and therefore all of these issues may make the PE very unstable. Got it, everyone? Right? Generally, people look at the leading PE ratios as a reference. Clear? Right? Yes. Justified PE ratio means what the PE ratio should be. Should be. Here, just to give you an idea about the justified PE ratio, which is based on the intrinsic value, where the price over earnings, where the price is based on Gordon's growth. So we use D1 over cost of equity minus growth. And since there is earnings, let's say leading next year. So this translates dividend over earning is what we call as payout ratio. Isn't it? Dividend of earning is nothing but your payout ratio, correct? Over cost of equity minus growth. So your justified PE, this is what we call as a Justified P. And since I've used the next year earnings, I can also call it as justified leading PE ratio. Am I correct? Leading next year earnings. Clear, clear, check, check, check. Right? Three components: the payout ratio, cost of equity, and growth rate. Everyone, check. Clear? Okay. Now, what if the companies have earnings which is negative? In that case, we might use other components or other ratios also, which is called price to book value ratio. Price to book value ratio, as I said, majorly it's used when the EPS is negative and companies relatively have a stable book value compared to the earnings. Okay. Remember here, when I'm looking at the book value, what is book value? Book value is total asset minus total liability, or you can say total equity based on the balance sheet. So it is also called book value, net asset value, shareholder fund, total equity, proprietors fund. It has different names, unfortunately, but all of they stand for book value, net asset value. Remember, net asset value, this is suitable for firms who have mostly liquid assets rather than illiquid or intangible assets. Correct? This has also a history of being accurate in most of the cases. But remember, this is not suitable for companies which are dependent highly on the human capital, like the IT business or consulting businesses, right? So it is not suitable for those type of companies. Also, this ratio can be misleading when there is different size of assets being compared here. Remember, book value is also derived from the balance from the management information. So there is a high discretion involved of the management, and it is also subject to manipulation. Correct. But the other problem is accounting convention. The differences in IFRS and US GAAP, how it is recorded, that will also impact the book value. And two more things: inflation and technological change can cause a huge difference between book and the market value. For example, companies like Apple and tech companies, their book value and the market value, the difference is 4 or 5 times. So in such a case, is the book value really comparable or not? That becomes a question mark. So it might not be an accurate measure when there's a huge change because of technology. Correct? Right? Price to book value is price over the book value, and book value, as I said, is shareholders equity. Shareholders equity, there are various ways of deriving shareholders equity. So now we will calculate what is the price to book value ratio. When I say price, that is price per share over the book value per share, and book value per share is nothing but total book value over number of shares. But what is book value? Book value itself is net asset value. Net asset value is total assets minus total liability, which is nothing but your debt. But since we are looking out the value for common equity, you will also subtract the preferred stock. Yes, very, very important. Normally, when you calculate NAV, you don't subtract the preferred stock because you're finding the value of total equity. But here, since we are valuing the common equity, remember this adjustment: for valuing common equity, you need to subtract the value for preferred also, because after paying the preferred, what remains is the value of common equity. So in the case of calculation of book value, here we are going to use the book value per share, but that book value itself is the value available for the company. It is the value of the company's common equity. Understood, everyone? Check, 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 check. They have said that you might have to do some common adjustment in real life. For example, you will have to do something related to those intangible assets. What are we supposed to do? As an analyst, you might adjust. So anything related to it, for example, adjustments to book value, create more useful comparison. Common adjustment is to use tangible book value and exclude the intangible, especially anything related to goodwill, which because you cannot monetize goodwill. So anything related to goodwill on the balance sheet or impairment of goodwill in the income statement, that needs to be adjusted. Also, they have mentioned that if the two companies are using different inventory valuation, you might have to adjust that as well. All of these adjustments, I don't expect them to be tested very heavily in exam. All you need to know that there might be some adjustment required. This is your price to book value ratio. Everyone with me on this? Check, check, check. Anyone has any doubt in price to book value? Easy, easy, easy. Correct. Now we are going to look at the price to sales, which is less manipulative because sales are difficult to manipulate compared to the previous two. This is generally used when the companies have a very high sales growth but not enough profitability, right? Price to sales is meaningful even for firms where the sales revenue is at least positive compared to others. So when other things are not positive, then in that case, P and price to book value ratio is not sensible. So therefore, price to sales ratio is more sensible in this case, in these cases, and they are relatively less volatile comparatively, and it's also more appropriate for stocks in mature as well as cyclical industry and even for startups who have negative earnings. So this ratio is more suitable for a broad type of companies. Again, here anything related to sales can become a disadvantage. So disadvantage is related to what is the growth in sales that you expect, correct? And growth in sales does not necessarily translate into profitability growth. So that is also very important. Also, it doesn't translate into high cash flow if the sales are on credit, correct? So it does not capture the profitability or cost structure, although it is less subject to distortion. But we have seen in the past that there are red signals, warning signals related to people pushing the sales or trying to put up an aggressive sales, right? Although very difficult to manipulate sales, someone, even the authorities who collect the indirect taxes like the goods and service tax or the VAT, they are very watchful of the sales. So manipulating sales is a very risky thing. In the price to sales ratio, we are going to take sales per share. Very easy. There's no rocket science here. In the price to sales ratio, PS, simply we are going to take price over sales per share. Okay, very easy. Hardly asked because there's no difficulty in this. Remember, whenever you compare the price to book value, price to sales, or price to earnings, you'll compare with the peers. And if your ratio is lower, your target company's ratio is lower, it is considered undervalued. Now, the most important amongst all the other ratios apart from P ratio is the price to cash flow, the third type of ratio, price to cash flow ratio. And here things will become interesting because what exactly do I mean by cash flow? So I know price over cash flow per share. But which type of cash flow should I take? Should I take operating cash flow? Should I take just the cash flow? Or should I take free cash flow? So there are various ways to basically conclude which type of cash flow should I go for. Yes, you can use any cash flow, but actually the cash flow which is most reliably used is the free cash flow. Free cash flow is more often used here. So which cash flow models will I use? There are various cash flows approaches. There are various types of cash flow you can use. Okay, I'll highlight all of them, which is going to be throughout the topic. One is a simple cash flow, which is earning plus non-cash. So which is earnings plus non-cash. Earnings plus non-cash. This is your simple cash flow, correct? But we have understood there are various other cash flows. There is something which is going to come up as adjusted cash flow or adjusted CFO. This is very interesting. This is slightly new. Okay, adjusted cash flow. This is going to be my normal cash flow. This is going to be my normal cash flow. Then what is my adjusted cash flow? Then we have the free cash flow based model, but we also use the EBITDA. Sometimes people use EBITDA plus EBITDA is EBIT plus non-cash. So that approach can also be used. So we use the free cash flow approach, and we might use the EBITDA approach also. So there are multiple approaches that can be used in terms of cash flow. Which cash flow, right? So we will see what are the different types of cash flow, cash flow, cash flow. See, where is the different types of cash flow? Let me highlight that. underlying earnings, normalized earnings. This is what we will see. We have that different types of cash flow, cash flow, cash flow, cash flow. Where is it? Different types of cash flow. Paired Yardini model, that is so much not important. Yes, see here. There are four definitions of cash flows, which is at the end, by the way. One is the cash plus earnings plus non-cash charges. That's a simple cash flow. Second is the adjusted cash flow. And what do I mean by adjusted cash flow? Adjusted cash flow is adjustment for the non-recurring items. Non-recurring, if there is a non-recurring income added, you need to subtract them. If there's a non-recurring expense that was subtracted, you will add them. So whatever is your normal operating cash flow, plus the adjustment for non-recurring, plus or minus, I will write the adjusted for non-recurring cash flows. When I say non-recurring cash flows, it can be a non-recurring expense or an income, but don't forget to do into 1 minus tax. Any expense or, and when I say non-recurring cash flows is related to non-recurring expense or income. Hear it out carefully. It is related to non-recurring expense or income. But whenever I say expense or income, don't forget to adjust for the taxes. Clear? Those adjustments they will mention us, that is your adjusted CFO. FCFE approach, I think FCFE approach, yes, FCFE approach and EBITDA based approach. So FCFE approach is pretty much simpler. You can use the cash flow formula here. Remember the cash flow formula for FCFE, sorry, for FCFE, the cash flow approach is CFO, which is net income plus non-cash minus working capital minus the fixed capital plus the net borrowing. This is how easier your FCFE will be. EBITDA approach is pretty much simpler. All you have to do is take the company's EBIT from the income statement, add depreciation and amortization, if any. That's your EBITDA approach, simple approach. Clear? These are the four components of FCFF, your price to cash flow, which we are going to see later on in detail. Correct? So all your four approaches, price to earnings, price to book value, price to sales, price to cash flow. I'll go back to the initial pages and step by step cover everything that we did. So we are going to use price to earnings, different approaches. What are the pros and cons? Price to book value. Why should we use price to book value? We will compare them to decide whether it's under or overvalued. Remember, whenever your actual PE ratio is higher than the industry or the justified PE ratio. Justified PE ratio is based on the intrinsic value. The result is same as what your result is between the actual price and the intrinsic value. That it is, if it is more, then it is overvalued. If it is less, then it is undervalued. Clear? Price to book value ratio, we already discussed different components. Price to sales ratio, we discussed, right? Remember one thing, there might be some adjustments in book value, which we already discussed. But when it comes to price to cash flow ratios, there are varieties of cash flows that we are going to see. But also remember that these cash flows are the least subject to manipulation. So amongst all other manipulations, cash flow manipulation is the most difficult of all. Correct? So price to cash flow ratio is actually more reliable. But P ratio is very quick and easy because cash flow, how to derive the cash flow, it's a very subjective thing. So people actually use price to earnings more rather than price to cash flow. Clear, everyone? Got it? Got it? Got it? Yes. Okay. Till this point, everyone clear? Okay. Now we are going to move into the detailed discussion of the justified ratios. Justified is where we are going to use the Gordon's growth approach. But there are in between some small concepts related to what is dividend yield approach, what is dividend payout, dividend yield, dividend payout. All these terms are very important when they use a term called dividend yield. See, dividend yield, or sometimes they use earnings yield. Okay. What is dividend and earnings yield? Basically, when they say yield, it is related to price. So dividend yield is dividend per share over market price per share. Earnings yield is earnings per share over market price per share. But dividend payout ratio is again dividend per share, true, but that is from the earnings. So dividend over earnings is your payout ratio, or simply the dividend payout ratio. Understood, everyone? Clear? Okay. Now we are going to highlight on something that is called as normalized earnings or underlying earnings. See, earnings are subject to manipulation. So we need to understand that whether these earnings are sustainable or not. So anything which is non-recurring, for example, remember something non-operating like sale or gain or loss on sale of assets or any restructuring or impairment charges which are non-recurring. We need to exclude them. So what is underlying earnings and what is normalized earnings? First, we will discuss what is underlying earnings here. Correct? They've given some examples and we've already discussed what is normalized earnings. Two important formulas are necessary with respect to the PE ratio in the earnings part. So I will discuss what is underlying earnings and then we will discuss what is normalized earnings. Actually, these are adjustment in the earnings because we know they are subject to manipulation. Underlying earnings are the one from which we will exclude. Basically, whatever earnings we have, from the earnings we will exclude. What are we going to exclude, everyone in the class? We will exclude non-recurring expenses and gains. So any non-recurring items, I call it items, whether it is a gain or loss. If it's a gain, remove it. If it's a loss, add it. Correct? Any non-recurring items, we are going to remove them. But remember these non-recurring items into, don't forget to do 1 minus taxes, because expense or gains, expense or incomes need to be adjusted for taxes. That is going to be your underlying earnings. Everyone with me? Check, 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 check. But what is normalized earnings? Normalized is something that we adjust for the cyclicality. Remember, we discussed that earnings are volatile. So what is normalized earnings? Normalized earnings adjust for this cyclicality. Sometimes the business is very cyclical in nature, and in that case, what is the time period we need to take? We need to probably take the middle of the cycle. But in those cases, which earnings do we take into consideration? So should we take the historical earnings or what should we do? We should take the average. So there are two approaches for normalized earnings. Basically, normalized earning is adjusting the earnings for cyclicality. Yes. So normalized earnings means adjusting earnings for what? The cyclical nature, cyclicality. Okay. Now there are two approaches is with one which is called method of average ROE and method of historical average EPS. Historical average EPS. So one is method of historical average EPS, and the second is method of, one is based on average EPS and second is based on average ROE. So second is method of average ROE. So I will write down, this is average ROE. Now remember, we are trying to find out earnings. So when I say average earnings, I will not take only the current earnings. We will take the earnings of, let's say, a particular average. So here we may take average, sum as the average EPS over some recent period, maybe the most recent business cycle, let's say last 3 or 4 years. So, or last 4 quarters. So we will take, let's say, couple of periods earnings and we will take an average of it. So let's say I will say EPS for period 1 plus period 2 plus period 3 plus you can go on and on plus period 4. So if I'm taking last 4 period, this can be annual, quarterly, whatever it is. So that divided by 4 will be my average earning. This is one easier way. The second is where you take the average ROE. ROE is net income over total equity. So here we will take average ROE, multiply with the current book value per share. So we will take the average ROE. So we can take ROE from last 4 years or 5 years. So we will take the average ROE and multiply that with the book value per share of the current period, which is basically T, or you can say T minus 1 if it's the past. Next year is T plus 1. So you can use T, or sometimes if they give you the past, you can use T minus 1. So basically, this is going to be your book value per share of the current period. Everyone with me? Clear, clear, clear. This is going to be your normalized earning. These earnings you need to adjust in case if they ask so. Got it till this point? Okay. Now our focus will be on all the formulas of justified P, which I have already covered. But along with justified P, we will look at what is justified P, price to sales, justified price to cash flow, and so on. So justified price to book value, we will look at all the different justified formulas. You can actually combine all of them together also. So justified ratios, we will first focus on all the justified ratio. Remember, in this case, all we are going to do is that we are going to replace the price, which is the actual price, to the Gordon's growth price. That is the only thing we are going to do. Rest all is perhaps the same thing. So justified P and actual P. A normal P ratio has the actual PE ratio, but whenever I say justified P, here we adjust for the prices. So justified leading PE, trailing P is what we are going to do first, then price to book value, then price to sales ratio, and so on. Right? Let's see all the three ratios. So we will write down for justified price to earnings ratio. Justified PE ratio. Correct. Remember, in this, I'm directly going towards the justified leading PE ratio. You can also find justified trailing PE ratio. So when I say the word justified trailing PE ratio or justified leading PE ratio, first of all, the justified word is related to the price. So when I say justified in this case, what happens by price becomes the Gordon's growth price. And trailing means the earnings are for the current year. Here the earnings are for the next year in the leading one, correct? Now, if I further compress this, or sorry, not compress, I expand this. So the price is Gordon's growth price. So what happens here? It is D1 over E0. So I'll also break D1 as D0 over E0. D1 I'm breaking up into D0. Here it is going to be E0 into 1 plus growth. That is what my D1 is. Divided by, this is going to be my earnings on both the sides, divided by cost of equity minus growth. Okay. Here it will be D1 over E1. So I don't have to apply the growth rate because both are adjusted for growth, over cost of equity minus G. Now, if you carefully notice D1 over earnings, this is nothing but your payout ratio, which is 1 minus retention ratio. So here we can actually, payout ratio is 1 minus retention ratio. Retention ratio, we use a term called B. So payout ratio is 1 minus B into 1 plus growth over cost of equity minus G. Here also it's going to be in the denominator, there's no difference, cost of equity minus G, but there is no need of growth. So it is simply 1 minus payout ratio. So if you notice, the difference between both is simply due to the growth rate. Everyone, correct, correct. So which one will be higher? Trailing will be higher or leading will be higher? Guys, trailing will be higher, isn't it? Correct. So when I say the justified trailing, what is the relationship? Justified trailing PE ratio and justified leading PE ratio. What is the difference between the both? Justified trailing PE ratio and justified leading PE ratio. It's the leading PE ratio in which I will add the component of growth, isn't it? So when I multiply the leading PE ratio with growth, it becomes a justified trailing PE ratio. Is that clear with the PE ratio? Check, 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 check. Got it, everyone? Now let's go to the justified price to book value, which is very interesting. Book value. Okay, this is where all your accounting knowledge also comes to play. So now we are going to justify price to book value ratio. Justified price to book value ratio. Now here, first of all, when I say price to book value, normally it's price over the book value. But when I say justified, again, how do I justify the price to book value? Normally, I would have simply taken price over the book value per share, basically, right? So this is my normal price to book value ratio, but now I'm calculating the justified. So justified price to book value ratio, this is where I will now utilize the Gordon's growth price. Now, Gordon's growth price, everyone, can someone highlight me? How do I translate this? Gordon's growth. What is my normal formula of Gordon's growth price? It is D1 over R minus G, or cost of equity minus growth, divided by the book value. So normally we start with the price. So what is my price? Price is D1 over the cost of equity minus G. But when I'm using the justified price to book value ratio, I will divide it by the book value on both the sides. So when I divide it by the book value, what gets translated? How do I convert my price to book value ratio? What will it eventually translate into? Yes, anyone has any idea? How will I convert the price to book value ratio from the normal ratio to the justified one? Yes. Any relation? Any relation? Remember the growth rate formula. What is the growth rate formula? Growth is retention into ROE, right? Correct. And how do I find the earnings? Earnings. Remember return on equity formula. Return on equity is net income over net income, which is earnings over total equity. Correct. So return on equity, I know, is net income, that is earnings over total equity, which is nothing but book value. So if I do everything per share, this is earnings per share into book value per share, right? Everyone in the class? So I know ROE is also earnings per share divided by book value per share. Now remember, if I want to convert this into the book value per share, I want to find the book value per share. So instead of book value per share, I can convert the ROE into something. So see, what it actually can happen is that I can rewrite the formula here. ROE is earnings per share over book value per share. So if I want to find earnings per share, I can basically do ROE into book value per share, or book value per share can be done in the either way. So now I'm finding the price over book value per share. Okay. Now for price, I use the Gordon's growth D1 over K minus G. But is there anything dividend over book value per share? Anything dividend over book value per share? ROE. I have earnings. Yes. So if I do here divided by the book value per share, But I have dividend can be, how can I derive the dividend? Dividend is nothing but earnings into the payout ratio, isn't it? Correct. So instead of dividend, I can replace that with earnings. So now if I do my justified price to book value ratio, dividend can be written as earnings into the payout ratio, which is 1 minus retention ratio over the book value per share. All of this divided by cost of equity minus growth. But I know that when I will have earnings divide by book value per share, this earnings divided by book value per share can also be replaced by ROE. So my formula now translates into what exactly? My formula translates into a very interesting thing is ROE into 1 minus the payout ratio. Correct? 1 minus the retention ratio, which is the payout ratio, over the cost of equity minus the growth. Understood, everyone? ROE into 1 minus B, everyone, over the cost of equity minus growth. Why? Because earnings over book value is nothing but ROE. Everyone with me on this? Correct? Eventually, you have to remember this formula. Your justified price to book value is ROE into 1 minus B over cost of equity minus growth. Correct. Everyone in the class, right? This can further be expanded also. Very interesting. What is my price to book value now? Check out this. I have ROE. I will expand. ROE minus ROE into B over cost of equity minus growth. Now, what is ROE into B? B stands for, everyone in the class. What does the B stand for? B stands for the retention ratio. And we know that when I do retention ratio into ROE, I get as growth rate, isn't it? So whenever I do retention into ROE, I can replace this with the growth rate. So my final formula is ROE minus growth rate over cost of equity minus growth rate. This is how I can translate the justified price to book value. So if you notice, the only difference is between ROE and cost of equity. If the ROE is greater than cost of equity, your justified price to book value ratio is higher, otherwise lower. So your ROE should be greater than R, then your justified price to book value ratio is higher. Everyone understood the final formula here? The translation and the final formula? Check. Clear? All you have to remember are these two formulas. First is the final formula of this justified price to book value, or you can also remember this formula. These two formulas you need to remember when they say justified price to book value ratio. Clear? Yes. So this is my first justified price to earning, justified price to book value. Now we will derive justified price to sales. This is pretty much simpler. So I have my price over sales, which is price per share over sales per share. Okay, this we already know. So here I'm just going to replace the price information. This is very interesting. So again, normally it starts with, when I say justified price over sales ratio. So what is my normal formula? My normal formula of price is Gordon's growth. Dividend over cost of equity minus G. But when I use sales on both the sides, so dividend over sales, and what is dividend? I can expand the dividend as earnings into the payout ratio, which is 1 minus retention ratio. I can use this instead of dividends divided by sales, correct? All of this divided by cost of equity minus growth. And I know earnings divided by sales is nothing but my net profit margin. Clear? So now if I calculate my justified price to sales ratio, my formula translates into earnings over sales. That is my net profit margin. That's the only difference between this and the P ratio. Yes. So net profit margin, everyone, into the payout ratio over cost of equity minus growth. Notice the similarity between the price to sales and price to earnings. Somehow they are connected, right? In fact, if I say, if I want to find justified price to sales ratio, I can actually derive it from justified price to earnings ratio, which has this component 1 minus B over cost of equity minus G. The only thing missing is net profit margin. So all I have to do is multiply this with net profit margin. Everyone with me? Check, 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 check. Understood? Perfect. Clear, clear, clear. Understood the similarity, everyone? Check. Perfect. This is your justified price to sales ratio. Justified price to cash flow ratio is very much simpler here, just that you have to take the Gordon's growth free cash flow. Okay. So when I say justified price to cash flow ratio, okay, let's say justified price to cash flow ratio. In this case, all you have to do, price to cash flow, there is no shortcut of the formula. All you have to do is that in case of price, you can take free cash flow. So here the price is FCF E over R minus G, or if you use FCFF, you get the value form. So you will here use FCF E in terms of price. Rest all will remain the same, correct? So divide it by the cash flow, whichever cash flow we've done discussion of different types of cash flow. There is also formula related to justified EV EBITDA. EV EBITDA, what is the EV EBITDA model and what is the dividend yield? We've already discussed the dividend yield, right? So apart from justified price to book, we have done the different varieties. Justified EV EBITDA, earnings before interest, depreciation and amortization, interest, tax, depreciation and amortization, that's your EBITDA. EV is the value of the firm. This ratio is generally used when the companies have when you're basically looking at the entire valuation of the company, when you're comparing the whole firm. So justified EV EBITDA, again here the EV is the market value of the debt equity adjusted for taxes, right? The enterprise value is based on the forecast of fundamentals divided by EBITDA based on fundamentals. Again, now here simply you have to take EV and EBITDA. Again, the EV has to be estimated. In the EV, remember, market value of equity will be estimated value based on Gordon's growth, the forecasted value. That's it. Otherwise, there's no difference. Correct. And then you will discount that valuation at WACC, because EV is for the whole firm. So you will discount, like FCFE, you discount with cost of equity, EV you will discount with WACC. Correct. Dividend yield, dividend over price, is actually the inverse of the P ratio. If you see dividend yield ratio, so very interesting thing. I will now add justified EV EBITDA ratio, justified EV EBITDA ratio. Remember, in justified EV EBITDA, you are simply going to take EV over EBITDA, where the EV is based on fundamentals and EBITDA is also forecasted, right? Fundamentals means the value of the equity there is based on the Gordon's growth. No need to memorize anything here. Justified dividend yield is interesting. Justified dividend yield. By the way, dividend yield is dividend over earnings. Dividend over price, which is inverse of the what? Here, see, dividend yield is dividend over price. Correct? Now, if you notice here, interesting thing, dividend over price, that's my dividend yield. What is it? Is it inverse to something? Yes. Anyone? Dividend over price, dividend over price. Price formula, we know. What is the price formula? Price is, we did price dividend over R minus G, or cost of equity minus growth rate. So if you look at dividend yield, in that the price is simply, yes, D1 over R minus G, right? Or cost of equity minus growth rate. Now here, if you reverse the formula, it is, let's say, D1, which is D0 into 1 plus growth rate. So let's say D0 into 1 plus growth rate over R minus G, because I'm taking it on the reverse. So if this goes as R, or cost of equity minus G, multiplied with D0 on the top. If you see, the D0 gets cancelled out. So the formula is cost of equity minus growth over 1 plus growth. This is your final output. Understood? Cost of equity, that is R minus G over 1 plus growth. This will be your final output. If you just apply some mathematics here, this is going to be your final output. Correct? This is the justified dividend yield formula. Okay, everyone, check. I have used the derivation here, how it translates. You don't have to remember or memorize the derivation. It's rarely tested in exam. So justified dividend yield I'm putting here, but again, very less chance of being tested in exam. Right? Now, very interesting thing is that P can also be predicted rather than deriving through this way. We can also predict using the linear regression model. Correct? Yes. So here we can also use the past information and predict the PE. Correct? So while empirical analysis can provide an analyst, there are some limitations for using this. First of all, we are going to take PE ratio based on historical information. Correct? So what are we expecting? We are expecting the past will continue. So there are some limitations, but we can use it. So what is the predicted PE approach? First, I will discuss that, and then I'll come to the limitation. For example, we've used a regression model. So here we have used a model where we have taken three factors into deriving the PE ratios, right? So we've taken dividend payout ratio, beta, and expected earnings. Based on this, we are going to derive a PE based on the linear regression. This is also one of the ways of deriving PE. Same like, it's a multiple regression model, correct? Now, should I use this model or not use this model? First of all, this is actually cross-sectional regression. So the predictive power of the estimated P regression for different time period for sample stock is uncertain. So we are using this model assuming there will be constant, things will be constant, which is not the fact. Things will be cyclical in nature. It will be uncertain. Also, the relation between P and the fundamental variables will change over time. So it is not going to be stationary. Remember, these all will violate the properties of linear regression. Also, multicollinearity. What is multicollinearity? It is a condition where there is a high correlationship amongst the independent variables. For example, earnings growth rate, payout ratio, beta, they are also highly correlated. So multicollinearity is generally a problem in all the time series regressions, correct? So using P or predicting P ratio based on this has its problems, but people might use them. Correct, everyone? Right? Okay. The last thing which is very important is that we use the PE ratios also for the index, which is generally our benchmark, isn't it? So we will use PE ratio in real life. We use the PE ratio of S&P 500 or Nifty or Dow Jones. We use the PE ratio and we compare those PE ratios and define whether the market is under or overvalued. Correct? So P ratios for the benchmarks are used, but the problem is that in benchmark there are various securities. So how do we derive the PE ratio? Do we take all the prices and all the earnings and just combine them? No, there are problems. There are problems. What are the three possible issues related to it? First of all, justified P is positively related. Okay. Okay. Suppose if we determine the P ratio of a stock is less than the benchmark or than the index, should I consider the stock is undervalued? Generally, we assume the stock is undervalued when a P ratio is below the benchmark, right? We say the stock is undervalued. But here they are saying that this might not always be the proper answer. It doesn't always mean it is undervalued. Yes, naturally, you might assume it is undervalued, but you can also assume two more. There are also two more possibilities that the stock is correctly valued, right? but has a lower expected growth rate than the benchmark. The growth rate is lower. That's why it is undervalued. Or its cost of equity is higher. That's why it is undervalued. So it cannot always be directly said it is undervalued. Correct? Now, how will I know whether it is truly undervalued or not? For this, they have said we have to make sure that the stock is comparable to the benchmark in terms of growth and the risk. So when the growth and the risks are similar to that of the benchmark, only then you can conclude it is under or overvalued. Got it, everyone? Right? Here, they have given two more models, the Fed and the Yardeni models. Now, I will write down the formulas of Fed and Yardeni models, but honestly, from the exam point of view, they are not so important. Fed model and Yardeni model have rarely been tested of late, but I will write both of these models. They are generally the models used to understand whether the market is under or overvalued. So if I want to know whether the market is under or overvalued, we use the Fed model or the Yardeni model. Again, I'll repeat, I'm writing down both the formulas, but it is slightly, less possibility of that being tested in exam. Fed model is used on the concept of bond yields and earnings yield. So the market earnings are actually compared to the bond, which is actually unrealistic, right? So Fed model considers the overall market to be overvalued when the earnings yield on the S&P 500 is lower than the 10-year treasury bond yield. So see, we are going to compare the earnings yield on S&P 500 with the 10-year government bond yield or treasury bond government bond yield. These both are compared, right? Earnings yield and 10-year government bond yield. So I will write if the earnings yield and government bond yield when they are compared. So if the earning yield is below the government bond yield, we consider the market is overvalued. It means the equity market is offering lesser yield than the bonds. So equity market is overpriced. So when the earning yields are low, we say the equity market is overvalued. This is what very famous it is. That is the Fed model. Correct? The Yardeni model taking, see what happens in the Yardeni model. We are going to compare the current yield of the market with again the bond yield. But this time we don't take the government bond yield, we take the corporate bond yield. So here the earnings yield of the market, current earnings yield, we are actually going to derive what? The current earnings yield, CEY, current earnings yield of the market. This is current earnings yield of the market. These are compared with the bond yields, right? So we are going to compare them with the corporate bond yield. This is actually A-rated bond, not a government bond, because how can you compare equity with a government bond? It's risk-free. So that is perhaps to an extent corrected. So it's current Moody's A-rated corporate bond. So I will say it's a A-rated corporate bond, right? But this corporate bond yield is compared to the long-term equity growth rate, and this long-term equity growth rate is not going to happen immediately. So it is assumed to happen over a period of years. So constant assigned by market earnings, that is about 0.2. So long-term equity growth rate into the factor. This factor is where the long-term growth rate will be, it is going to be constant over a period of time. So sometimes, this long-term growth rate won't be forever. It will be, let's say, for 5 years or 10 years. So that long-term equity growth rate is compared. The difference between both is called the current earnings yield of the market. I'm writing it, to be honest enough, you do not have to think from the exam point of view. You can simply understand and skip it. The more important ratio is actually the peg ratio. Not all of this. Peg ratio is more important, where we are going to see the P ratio. Does it justify the growth? Because see, High growth companies will have a different PE ratio compared to a more mature companies. So what is a PEG ratio? PEG ratio is actually price earning ratio justified for the growth. Yes, very, very important. This, I believe, is more important than the Fed and the Yardeni model. Remember, we did the relationship between earnings and P is captured by the PEG ratio. PEG ratio is price earnings to the growth ratio. Here, this it tells you for every unit of growth how much is the price. Remember this ratio. Do you want it to be higher or lower? If you want to find undervalued stocks, this ratio needs to be higher or lower. Check, 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 check. Right? First of all, it standardizes for differences in growth. So this is for standardizing for difference in growth. Now, this ratio lower means undervalued. So when this ratio of the subject is lower with the benchmark, we call it is undervalued, because then at, let's say the two companies have same growth rate, but if one of the subject is at a lower P ratio, then it is undervalued. So we want the P ratio of our subject to be lower, the PEG ratio to be lower, same. The decision is same as what the P ratio is. So this ratio needs to be lower compared to the benchmark. Correct? Then we call it as a, what do we call it as? We call it as undervalued. Correct? There are a few more things related to, the justified P ratio. We discussed how to adjust for the cash flows, as well as how to adjust for the earnings and all for the non-recurring items, right? On the price value, we've already discussed is market value of stock, debt, market value of preferred and common stock, as I said, debt and cash and equivalent. So I'm not going to repeat the same formula. It is the same formula which we already covered up, right? Correct. What else do we have in EV/EBITDA? We've already covered EV/EBITDA. When is EV/EBITDA important? It is more useful when PE firms with different degrees of financial leverage. So when companies have differences in the leverage structure, EV/EBITDA is more useful rather than price to earnings. In fact, you can use price to book value also, but EV/EBITDA is more preferred, right? It is useful for capital intensive business where there is a lot of depreciation and amortization. So all this non-cash might be draining the earnings. So in that case, EV/EBITDA model is more useful, and also useful when the EPS is negative. In such case, EV/EBITDA model is used. But again, like any other model, EV/EBITDA has drawbacks because EBITDA is derived. EBITDA is not published by the companies, it is derived by the analyst, right? So if working capital is growing, EBITDA will overstate the CFO. Why is that the case? Because in CFO calculation, we use what? We will overstate the CFO. So if working capital is growing, EBITDA will overstate the CFO. Again, remember EBITDA, earnings before interest, depreciation, and tax. Because the depreciation and tax, amortization will be higher. In those cases, the EBITDA will be relatively higher. Correct? So all of this will actually put a pressure on the cash flows. So EBITDA is not a relevant measure, especially in terms of there is a possibility that if the company is expanding, the company's EBITDA will be relatively higher. Okay. Further measure ignores how different revenue recognition policies affect CFO. So it's always tested to other models of cash flow. So EBITDA is actually, the closest to operating cash flow, but not exactly operating cash flow. Remember, when I say operating cash flow, it is net income plus non-cash, less changes in working capital. So cash flow from operation has working capital subtracted, which EBITDA does not have. Correct? All of these are issues, right? Now, the overall company's value you can use using EV, or you can also use using total invested capital. Now, there is a difference in the valuation of EV. So they are saying alternative measures of company's overall value is total invested capital. Total invested capital is market value of invested capital. So now I will highlight that in order to calculate EV, there are two approaches. One is where we take market value of equity plus market value of debt plus market value of preferred minus cash and equivalents. This is one of the approaches, right? The another approach is total invested capital. What is total invested capital and how it is different? Here also we are going to use the market value of equity, correct? And which value we are going to use? We are going to use market value of invested capital. When I say market value of invested capital, remember in enterprise value, we took the market value of equity and debt, but here the cash was subtracted. In the total invested capital, we do not subtract for cash. So we are only looking at the invested capital. So we only look at market value of equity, market value of debt, and market value of preferred. The cash part we do not subtract. That is called our total invested capital. Understood, everyone? That's the only difference. Clear, clear, clear. Okay. Then we are going to look at the unexpected earnings surprise and standardized unexpected earnings surprise. These are the terms that are there in the syllabus. So I'm just highlighting them. Unexpected earnings surprises. This is basically indicators which will help us. These are technical indicators. Whenever there is an earning surprise, it creates a momentum where the stock starts rising. If it's positive, if it's negative, it will start draining. So earning surprise is what? It is the difference between what was expected by the analysts and what actually turned out to be, right? So it is the difference between reported EPS and what the analyst expected. So expected EPS, it can be positive or negative. This is also translated into a ratio. So unexpected earnings surprise or earnings surprise is also translated into a ratio called standardized unexpected earnings. So we call it as standardized and here we are looking for unexpected earnings. Okay, standardized unexpected earnings, which is also called the surprise. Now this is simply nothing but it's a ratio of what? The earning surprise divide by the standard deviation of it, because we want it to be we want to make it sure whether it is very volatile or it is consistently, giving a surprise. Correct. So very interesting analysis here. So first of all, it is earning surprise over standard deviation of this earning surprise. Standard deviation of this earning surprise. Now, very important thing, given a size of forecast error is more meaningful, the smaller the size of historical forecast errors. What does it mean? So we are going to look at the volatility in this surprise or in this forecast. Why are the analysts always wrong? Is there something, that the company is doing to keep it earnings low amongst the analysts? It's not giving enough information. And then suddenly you see the earnings going up. That is also companies can do it, right? So here, given the size of forecast error is more meaningful, the smaller the size of error. So we want the standard deviation of the earnings surprise to be low. Otherwise, we probably think that the earnings are, manipulated, right? So we need positive surprise or negative surprise. Well, we need positive surprises, right? Positive surprises, which will lead to positive abnormal returns. But there should not be high volatility on the positive and negative both. So the standard deviation should be low. Clear? Relative strength indicator is a technical indicator where we are going to compare the performance of a stock to the benchmark. We can put up a trend line and see over the history what has the stock done compared to the benchmark or to the peers. It's a technical indicator. Okay. But remember, I was discussing when we are going to look at the P ratio of a stock index has multiple securities. So here using arithmetic weighted mean or harmonic mean will not give us accurate result. Here we have to use the weighted harmonic mean whenever we are looking for the PE for the index, when we are looking for the P for the index or portfolio, we should look at weighted harmonic mean. Very important. Normally for harmonic mean, what do we do? We've done in level one, we take the number of investments divided by the inverse of the prices, right? So we take normally for what do we do for harmonic mean? 1 over R1 plus 1 over R2 plus 1 over R3. Sometimes we use R, sometimes we use price. So here also we can use different, here instead of doing what, instead of taking the R, which was basically used as the returns or price, we can use the different ratios. So here we can use the inverse of the PE ratios. So whatever the P ratios we have, we will use the inverse. Normally in the harmonic mean, we would be doing this, right? We would be taking the P ratios. We cannot use arithmetic mean, because in arithmetic mean, what will happen? We are simply taking the average, right? But that will not be the accurate data. So when I look at the PE ratios, we will take the inverse of the PE ratio. Let's say PE ratio of stock 1, P ratio of stock 2, P ratio of stock 3, and so on. This is how we will take the inverse. But the problem is that, let's say if there are three stocks, this is the harmonic mean, right? What is weighted harmonic mean? How is it different from the harmonic mean? That is important. Here, the difference is related to weights. So when I take weights, the total of all weight is always 1. Total of all is always 1, and then I will take the weights here, the weights of the prices. So based on whatever the prices, we will take the weights of all of them. So it's not only simply here that I'm taking the harmonic mean, I'm taking the weighted harmonic mean. So here we will take the weight of 1, weight of 2, weight of 3. I'll just show you so that you understand how we've done here. So this example, we got the PE ratio, correct? Right? If I simply take the PE ratio of the combined index, assuming there are only two securities in the index, I take both their price, both their earnings, my PE ratio turns out to be 8.67 in this example. Now, if I do the same using arithmetic, weighted, or harmonic, I won't get 8.67. To actually get 8.67, one way is take all the prices, all the earnings, divide by them, you'll get the P ratio. Or you use the weighted harmonic mean, where I've taken the price 10 and 16 for the weights. So 10 divided by 26, 16 divided by 26 is my weights. These are my weights based on price into the inverse of the PE ratios for both 10 and 8. And since the total of weight is 1, so in the numerator you have 1. That's how my weighted harmonic mean is. Only then I'll get the accurate answer. Otherwise, if I take the simple arithmetic mean, I will not get an accurate answer. Got it, everyone? Correct? Check, 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 check. Clear, clear, clear. Yes. Anyone, any questions? This is so many formulas, all of them combined here. This is the topic with the maximum formula throughout the syllabus. The rest all, residual income, private income valuation, they don't have as much as formulas as this particular topic has, right? Let me know if there is any formula missing. We've covered almost all the formulas. Now we'll move to the residual income valuation. Yes, anyone, any questions? So let's start with residual income valuation. Now, this is slightly newer concept compared to what you did in your level one. In this topic, we are going to look at a profit or a type of profit, which is not your accounting profit. It is actually economic profit. So this approach is also called economic profit approach, where we are going to see how much is the available earnings after paying out to the equity shareholders what they minimum require. So remember, the equity shareholders require cost of equity, that is the minimum required return. So after paying off that returns, what is left with the company is called the economic profit or the residual income. Now, with that income, you can reinvest or you can pay out as dividends. Correct? So, residual income approach basically measures the opportunity cost of capital. So, we are first going to understand the formula of residual income. Correct? Then we will also look at the other approaches, including EVA, economic value added, and market value added. These are also based on the similar concept. These are all economic profit measurements. They are not similar to your traditional accounting profits. Minor difference in all of them. We will consider all of them, and then the entire focus will be on residual income. So first of all, I will actually do EVA and MVA, and then the entire topic will be focusing on residual income only. So first, let us understand economic value added and market value added. So economic value added is the value added to the shareholders. When I say shareholders, to the equity shareholders by the management. So see, the management is expected to earn some minimum return on the capital. And after that, whatever is the extra that is the management has added to the company's valuation, that is EVA. EVA, yes. EVA, EVA. So we will write down what is the formula first, EVA. Then we will write down for the formula of market value added, economic value and market value added. So EVA is the value added over and above what is required by the company. Remember, the company needs to earn weighted average cost of capital on the total invested capital. What is total invested capital? We just saw total invested capital is the debt and equity both. Correct? Debt and equity both. But here, when I say debt and equity, I'm looking at the long-term debt and equity. That's my total invested capital. On that, whatever is the WACC, this is the minimum that I need to earn. So EVA is the amount over and above this. Over and above this, basically we look at net operating profit after tax. What is NOPAT or net operating profit after tax? It is nothing but EBIT into 1 minus tax rate. That's your NOPAT, net operating profit after tax. Why do we take net operating profit? Because we are looking at the value for the entire firm, how much extra the value of the firm has generated. Correct, everyone? So this is long-term debt and equity, right? Now, there are some differences which I will cover up, but then what is market value added? Market value added is similar to EVA, but market value is the difference between the value of the company's long-term debt and equity based on market and something based on the historical book value on the balance sheet. So here also it is the difference between the market value of the company's capital compared to the book value of the company's capital, right? It measures the value created by management's decision since the inception, because guys, market value is the cumulative. The book value or the market value is a cumulative value. So till date, whatever is the value addition done by the management, that is the market value added. So market value added approach is the difference between market value and we say the book value. Market value of what? Market value of long-term debt and equity. Market value of long-term debt plus equity. And we are going to see the difference between this and 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 we actually write the book value, but instead of book value we here use as the total capital, but this total capital is going to be based on book value of invested capital. So we write book value or total value of invested capital. When I say invested capital, it is the same thing, that is long-term debt and equity. Book value of invested capital. Again, this is nothing but debt and equity, same thing, right? So it is book value of equity, book value of long-term debt. Remember, book value and long-term value, right? Remember, this is long-term debt and equity based on market value. And this will be based on book value of long-term debt and book value of equity. Book value of equity is total equity, retained earnings, total equity, that is equity share capital, retained earning, and so on, right? Just a small difference when I say market value of equity. Market value of equity is nothing but the market cap. which is number of shares into current market price. That is how I get the market cap or market value of equity. But book value is based on the balance sheet value, right? This is the difference between MVA and EVA. There is also one minor difference here. When I look at the EVA in this, when I look at the total capital, it is based on the beginning values. Yes, total capital, long-term book value of long-term debt and equity. This is based on the beginning value, correct? For the EVA. But when we look at the MVA is based on the total capital, but at the end. So just a minor difference here. When I look at the book value, these book values are taken at the beginning period, and these book values are taken at the end of the period. So these are done at the beginning valuation, and these are done at the end of the year valuation, right? This is just a minor difference. Unfortunately or fortunately, you don't have to worry about it, because in exam they will perhaps mention it, right? If not, it is better you remember this minor difference, which is very easy to miss. Clear, everyone? Right? EVA and MVA, both the approaches tells you that how much is the contribution of the management in the growth of the company. Correct? This is basically economic profit. Now we will focus the entire topic on the residual income approach. Residual income, again also called as economic profit, is the extra income, but this residual income is for equity. Unlike MVA and EVA, which is for the whole company, residual income focuses on the equity shareholders. Yes, so residual income or economic profit is similar approach, but instead of operating profit, I take net income, and instead of WAC, we use something called as equity charge. Equity charge means how much is that I need to earn for my equity shareholders. So the amount of equity capital, correct? That we multiplied with not WAC, but here we use cost of equity or KE, or the minimum required that we need to earn. This is going to be my residual income or economic profit. Correct? Everyone, net income, that is earnings. Now this can be translated further into net income. If you want to do it into per share, it can be earnings per share minus equity charges, equity value, which is the book value of the equity, into the cost of equity, that is R. Okay, so this is nothing but the book value, let's say the past book value, into the cost of equity, which is nothing but KE, or you can use R, it doesn't matter. This is the original formula of residual income. Everyone with me? Check, 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 check. It's all into per share, right? Correct, 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 correct. Yes. Now, this formula can be further translated into a shortcut, because we did some of these components previously already, right? How do I convert this book value and earnings? Is there a relationship between book value and earnings that we saw? Yes, we saw a relationship between ROE, earnings, and the dividend formula. So I'll write down all those formulas, and eventually what I will realize is that there is another formula of this residual income. One formula of residual income is based on EPS or earnings. So I will rather write this properly. This is nothing but earnings per share, correct? This is one way of finding residual income. The other way is based on your formula of ROE and R. Yes. So another approach of residual income is ROE, return of equity, minus R, that is nothing but your cost of equity. This, what you can do is that you can take a difference between both and multiply with the book value. The book value. Here, which book value should I take? Should I take the beginning or ending? I think we should take the ending, right? I made a mistake here. In the residual income, in the MVA and EVA, we take the beginning value. Here we take the current book value, the ending book value, ending book value. Let me see and confirm that. See, like EVA and MVA, I think we take the ending value. Yes. forecasted book value in year t minus 1. No, we take the beginning value, correct? Oh, value per share in year t minus 1. So it's current book value only. Am I correct? Yes. Current book value, right? Okay. So here we multiply that with the book value. You can directly utilize this. So both the formulas are actually the same thing. Now I'll just help you derive this for your reference. How did I come to this formula? It is basically a combination of, remember the original formula is earnings per share. I can derive earnings as nothing from the ROE formula. Remember, ROE is earnings over book value. So earnings over book value. So if I do book value into ROE, I can get earnings. Correct? So in the original formula where I have residual income is earnings, I can replace that with book value into ROE minus book value into cost of equity, sir. So if I pull out the book value, the difference is ROE minus the cost of equity. That's going to be the difference. So if the book value common is pulled out, what you will eventually get is ROE minus KE. Correct? That's the formula. Clear? Clear, everyone. So these two formulas of my residual income like FCFF and FCFE. Again, remember, these are economic profits, right? So throughout the syllabus, you will see the formulas either use this earnings minus the equity charge into book value, or you can see the difference between ROE minus R into the book value. Both the formulas are acceptable for you to find residual income. Mostly in exam, they will ask you to find residual income and value the company based on residual income, same like our Gordon's growth rate. Just remember that instead of dividend and free cash flow, we are replacing that with residual income, correct? But when I do that, I get to find the value of the company. I need two more things. Residual income will only tell me the extra, that the profit of the company beyond what is the current book value. So I need the current book value plus the extra. So in order to find the value of the company, we need not only the residual income's present value, future residual income present value, but I also need the current book value, because remember, residual income is extra. So when I'm going to derive all of this into valuation, all of this I'm going to translate into valuation. So my V0 is current book value also plus the present value of, instead of saying future dividends or free cash flow, present value of future residual income. Yes. So I'll perhaps forecast residual income for the future at the current book value. That's how my intrinsic value will be derived. Everyone with me? Correct. All right. Okay. Okay. Everyone. Now, this value tends to be recognized earlier in RI approach. Now, comparing RI approach with dividend discount model and free cash flow, very important. Now, if you notice here, compared to dividend discount and free cash flow, where is the biggest value? The biggest value is the terminal value. And if you see, terminal value is at the beginning or at the end. In the multi-stage dividend discount or free cash flow models, the terminal value, which is the biggest component, is it at the beginning or at the end? Yes, check, guys. Is it at the beginning or at the end? Terminal value is later, right? But in the residual income approach, the biggest valuation is the book value, current book value, which is at the beginning, right? So the bigger valuation in residual income approach is right now. So the present value of the bigger value is higher. So therefore, compared to the two approaches, the residual income approaches recognizes this valuation earlier, which is the current book value, which is not forecasted, which is actual. So compared to the dividend discount and free cash flow, which are very subjective because terminal value is going to be at the end, which is forecasted and which is uncertain, residual income approach is considered to be fairly better than the two approaches because it recognizes the majority of the uncertain value today, and this value is not uncertain because it is actual value. So it has relatively lesser error compared to both the approach. Keep this in mind. Very, very important point. This is, it has relatively lesser forecasting error. Everyone with me? On residual income approach, check, 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 check. Very, very important amongst the theoretical part. Rest all is fine. The theoretical part, this is the most important. Compared to the dividend discount and free cash flow model, residual income model has lesser forecasting error. Clear? Everyone, right? Overall, now we are going to value the company based on the residual income approach. So here, as I said, it's the current book value, correct, which is B0 plus the present value of future residual income. And what if this present value of future residual income is growing at a constant rate? Then you can use the Gordon's growth approach as well. So now the future residual income, present value of the future residual income, it can use different, you can use different method. You can use individual like dividend discount model for a limited period or perpetual growth rate, right? This is where the formula becomes very interesting, because if I'm going to use a perpetual residual income, if, let's say if the residual income is perpetual, how do we use it? So here, remember the residual income is ROE minus cost of equity. I'm using the shortcut into the book value, which is the B0 itself, correct? Over cost of equity minus G. This is going to give me a perpetual value. This is going to give me a constant growth rate. If there's a constant growth rate in the residual model, right? Otherwise, you can have individual residual models also. So this is what this component is, the present value of future residual income. Okay, assuming it is going to grow at a constant. So this is based on a single stage model. But then what we have done in the later part of the syllabus, we have taken different varieties. What if this residual income is going to continue growing or not growing? In that case, we use something called as the persistence factor, which is what we call as W. So that persistent factor, which we did in the note, so instead of going to this Tobin's Q and all, I'll directly connect with what is the persistent factor that we used. What happened to my notes? Persistent factor. Where is the persistent factor? Yes, see here, not here, sorry. Yes, everyone in the class. Persistent factor basically tells us that this projection of the residual income is not going to be practically constant. It will fade over the period. So we are going to use here four assumptions. Assumption is, what if the persistent factor, actually this W ranges from 0 to 1. So I need to write here this W, which ranges from 0 to 1. So what will happen if the persistent factor is 0, 1 or great, it cannot be greater than 1. So in those case, what it will happen to my formula? So either it will be 1, 0 or in between. So we will use all the scenarios when it is 0, when let's say it is 1, and let's say it is somewhere between both. In those case, what will be my present value of the future residual income? So let's say this happens at a specific year in the future. Let's say this happens at, we are trying to find the terminal value based on the residual income. So this terminal value, let's say the residual income initially grows at, for the initial year, it grows at 5%, and then it will fade out. So then my terminal value in that year, let's say we have done in the example also in the class, let's say the terminal value is at the 4th year. So what will be my terminal value of the residual income? This is going to be based on that year's residual income, correct? Plus the next year's growth. So we will say RI, let's say 5. It's same like for terminal value for year 4, we take D5. But then in the denominator, it is going to be very interesting. The formula here is that we are going to take into consideration now two things. current book value and initial high growth rate residual income, let's say for the 3 years, but then the final present value of continuing residual income. So what we are doing is that we are trying to derive this as the present value of continuing residual income. This is after assuming that the company is growing the residual income for the next 3 years, and then it is going to grow at a constant rate forever. In this case, the formula is residual income over 1 plus R minus the persistent factor. So it is 1 plus R minus W, 1 plus R minus W, 1 plus R minus W. This is the formula. So eventually what will happen in this case? So here my residual income for, let's say, fifth year, residual income for fifth year, we have already considered fifth year because we are finding the terminal value for fourth year. So this will be fifth year residual income, correct? Divide by 1 plus R minus W. Now imagine here the W is 0. What does the W 0 mean? Means it will immediately fade out. So let's say the residual income was growing at 20%, immediately it becomes 0. What happened over a period? It immediately becomes 0. In this case, my W becomes 0. So the formula will be simply 1 plus R. So it is going to be just 1 year valuation. But when the W is 1, means it will grow at this rate forever. Then it will become 1 plus R minus 1. So it will be simply R. This will have the highest valuation, this will have the lowest valuation, and this will be somewhere in the middle, because let's say if it is 0.4, so it will be 1 plus R minus 0.4, somewhere between both. Understood this, everyone? Check, check, check. This is going to be present value of residual income. So now my valuation will be now based on three things: the current book value plus present value of residual income in two stages. One is the high growth phase, and then is the constant growth phase. This is when I'm going to use multi-stage residual income model. So present value of high growth residual income. So it is present value of residual income, present value of residual income in high growth phase, and this is present value of continuous or continuing residual income. Now this is what we just did here, present value of continuous residual income. Understood, everyone? Check, check, check. This is the maximum deviation that can happen. This is the maximum complication which can happen with respect to residual income. All of this will be provided. You are again going to use the cash flow function, bring everything to the present value. There is no further complication into the model at all. Everyone, correct, 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 correct. Okay, let me go to this part. This is what throughout the syllabus is. Sometimes they will ask us to use the considering the current price, find the implied growth rate or implied cost of equity. We are going to use trial and error there. I will show you that in the syllabus how we are going to use the trial and error model in that case. Got it, everyone? Yes. Okay. Now, just give me a moment. Okay. Yes, there is something called Tobin's Q, which we will come up in a moment. But before that, let me discuss that the closest relationship of residual income model is with the price to book value ratio. Remember, in the price to book value ratio also, we've used the same components, correct? But is residual income model better than the other model? We've already discussed that it is better in terms of the case that there is a less forecasting error in this model compared to all the other approaches. So this is relatively the better model compared to the two. Therefore, even though it includes earnings and not cash flow like the free cash flow, this model is relatively more preferred. Okay. Now, in this model, there is a very high correlation with the book value, price to book value. How is that so? Remember in the justified price to book value, in the justified price to book value ratio, we use the same components. Yes. So justified price to book is directly related to expected future residual income. Correct? How is that so? Can someone remind me what is the justified price to book value formula? Everyone in the class, justified price to book value. Remember price over book value, where we replace the price with the Gordon's growth. Correct? So we will write down here. Again, I will write down what is my justified price to book value ratio. Everyone, if you notice, what is my justified price to book value ratio? Yes, where we compress the formula into ROE minus the growth over cost of equity minus growth. Am I correct? Right. Now, if you notice in our current V0 formula of residual income, right, we are using almost the same components. We are using the current book value plus present value of our residual income. If you see on the Gordon's growth basis, it is ROE minus growth. Correct? ROE minus growth, which is same ROE minus, I have used here, sorry, my mistake. ROE minus cost of equity into B0 over KE minus G. So if you see ROE minus, not growth, sorry, cost of equity into the book value over we use cost of equity minus G. Now, how are these two related? Here you have ROE minus G over R minus G. Here you have ROE minus cost of equity into B0 over K minus G. How are they both related? They both are using the same component. Am I correct? Right? Right. So if you see here, the conclusion derived by both is almost the same, because they're also in the justified price to book value. The ratio is higher if the ROE is greater than cost of equity. Here also, the ratio will be higher than the current book value if same thing. If the ROE is greater than cost of equity, then the value of the company will be higher. So for both, for justified price to book value ratio and for intrinsic value using residual income, for both of them, the most important component is ROE and cost of equity. So if the ROE is greater than cost of equity, your price to book value ratio is higher and your valuation is also higher. Understood? So in both these cases, the component required for the valuation are same. So if I'll conclude here, what is going to be the most important conclusion that we did, that if the ROE is greater or less than cost of equity, what will happen in that case? First of all, ROE, if it is less than cost of equity, there's no point of doing the business. So if the ROE is equal or greater, let's assume those two scenarios which are more practical. If the ROE is greater or equal to the cost of equity, in that case, what will happen to my valuation compared to the book value? If the ROE is equal to cost of equity, guys, this both component will set off each other. It will become zero. The second component, present value of continuous ROE, will be zero. So the current value of the company, intrinsic value, will be equal to book value only. But if it is positive, then the current value of the company will be higher than the book value. Similarly, what with the justified price to book value ratio? The justified price to book value ratio, if you notice this justified price to book value ratio, will it be greater than 1 or less than 1? We have to compare, will it be greater than or 1 or less than 1? If they both are same, it will be equal to 1. Otherwise, it will be greater than 1. This is going to be my conclusion comparing when I compare the ROE and cost of equity for both of these formulas. Everyone with me? Check. Very important conclusion. Got it? Right? Okay. Check. This is what we will be doing up. This is how these two ratios are highly related. Okay. We are going to do Tobin's Q. This is implied growth rate and implied cost of equity. We will just do trial and error when we see the questions. Correct? No problem in that. Continuing residual income we just did. There is this assumption which I'm just waiting for, this clean surplus violation assumption. This is very interesting notes that we made, amazing work we did, right? We will see a complicated question where we will have multi-stage, but that is rarely tested in exam. Yes, strengths and weakness, we've although decided or discussed this strength and weakness of the residual income approach. Here, the residual income approach, as I said, has relatively less forecast error, and that is perhaps going to be the biggest asking point for them when they ask in exam also, that what is the biggest strength compared to the two other approaches. So we'll have to compare them with the other approaches. So here, first of all, terminal value does not dominate the intrinsic value. So therefore, it is less dependent on the, there is a less chance of error, correct? And this model is also used whenever there is a possibility or that the earnings is negative. So we will use this model when the company doesn't pay dividend or free cash flows and everything is negative or they are volatile, correct? Residual income model, however, uses accounting data, even though which is easier, but it is subject to manipulation, correct? Right? Also, it requires a lot of adjustments, which we've seen in the past. Residual income does require a lot of adjustment. One of the drawbacks of the residual model, which we are going to see, clean surplus violation, which I will discuss in a moment. But when should I actually use this model? I should use only the model when the company is not paying dividend or its payments are not volatile or if its cash flows are negative. In those cases, residual income model is more useful. And also when the terminal value you're not sure about, it's highly uncertain, then it's better to rely on a residual model. But it is not appropriate when this happens, when there is a clean surplus accounting violation, which I will just discuss with you. When this is violated, what is the case? And when there is uncertainty regarding the book value. Okay, so the book value estimation itself or return on equity estimations are not reliable. In that case, you can't use this, which is very rare possibility. But what is this clean surplus accounting relation? Remember, the difference between the last year's book value or equity value and current book value should be due to two reasons, that is net income and dividend, isn't it? So what is clean surplus violation? Clean surplus violation, basically your book value ending and book value beginning. The difference between both, book value ending is actually book value beginning plus net income minus dividend. This is what it should be. But when these two things don't match, that is what we call as clean surplus relation violations, or simply said as clean surplus violations. When these things don't match, when the ending value doesn't match to the normal equation, that can be due to majorly all the reasons of OCI, because not everything goes into the income statement, right? There are many adjustments which are directly charged into the equity. All the four adjustments of OCI: pension related liabilities, foreign currency translation gain and loss, derivatives hedging, unrealized gain and loss, unrealized gain and loss due to FVOCI. All of these or any differences in the accounting that bypasses the net income, that results in clean surplus violation. And then relying on then trying to value the company based on residual income is not appropriate. Okay, this is one of the biggest drawbacks. Clear, clear, clear. Also, we are using the accrual method of accounting, so we might have to do a lot of adjustments. I don't expect you to memorize all these adjustments. Just remember, these adjustments are necessary for making it comparable. Most of these adjustments are related to the balance sheet. Balance sheet, whatever is the adjustments between two companies using different accounting treatment, that you have to use. Most of these are the similar thing. Also remember, analysts generally ignores intangibles, especially related to those which are unidentifiable, right? We recognize the identifiable intangibles, but unidentifiable intangibles like goodwill is what we do not recognize when it comes to the residual income valuation. However, you will have to adjust for some of the differences in the treatment of IFRS or US GAAP with respect to research and development expenses. All of these needs to be adjusted. How they are adjusted is very rarely tested in exam. Also, non-recurring items, we have already discussed that we might have to adjust for non-recurring items or any differences in IFRS and US GAAP. We need to adjust. That's the whole point of residual income. Again, a lot of adjustment because there is a lot of accounting information. One, even though it's not asked, I have seen they repetitively put up in the notes, but actually I have not seen, or sometimes I confirm with the students, which I should not, but based on my knowledge, I can say that the Tobin skew, which is actually a ratio, I have no idea why they have put up that, and only a ratio that they've put, nothing else. Okay, so there is this Tobin skew, which I will also highlight here. I'm writing because we are doing all the formulas. So what I'll do is that I will also write down that in the formula, but there is a high chance that this might not be tested. So this is Tobin skew, right? Which is a ratio of the company's market value of capital, that is debt and equity, to its replacement cost of assets. Replacement cost actually takes into consideration the inflated cost of the assets, right? This ratio should be higher. The higher the ratio, better it is. It tells you the productivity of company's assets, whether the company is using its assets appropriately or not. Means company today, if it replaces the asset, right, it should fetch more than that when I look at the market value of the company's capital. So that's called Tobin's Q. Okay, so I'm just writing this formula, although I don't see a lot of relevance of this. So I'm writing it at the end. Okay, Tobin's Q, and I'm also writing higher is better. Okay, it tells you the productivity of your assets. So on the numerator, we have how much company's valuation is as of now, the value of company's market value of debt plus market value of equity. Why both? Because assets are funded by debt and equity both. Correct. So what is the market value today? It should be higher compared to the replacement cost of the total assets. Replacement, because see, total assets on the balance sheet are depreciated. So today, if we replace them, replacement cost of total assets, what is the amount that we will have to pay if we want to buy them today? Based on that, the company's market value should be much higher than that, right? If that is the case, then we say the company has done a better job. It has utilized its assets more efficiently. That is Tobin's Q. Clear, everyone? Check, 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 check. All the ratios covered, all the ratios covered. We will utilize them in the same concept as what we did for Gordon's growth, for dividend discount and free cash flow model. That's the end of your residual income model. Very, very interesting, highly connected to your justified price to book value approach. Okay, everyone, check, check, check. Any questions? Okay, now let's move to the last topic, that is private company valuation. Okay, everyone, all set? Yes. So we are starting with private company valuation, the last nail in the coffin. That is the last topic. Until now, most of our valuation was based on those companies which were listed. So where getting the data is much more easier. These are stocks which are listed, so they have high liquidity, correct? But those companies which are not listed, they are relatively more riskier than the listed companies, correct? These private entities can be sole proprietorship, joint ventures, partnerships, etc., or those companies which have delisted. They were previously public. Now, they face relatively much higher risk than the public companies. These are company specific factors or stock specific factors. Company specific factors can be positive or negative. These are different stages of life cycle. Most of these private companies are less mature, their size is relatively lesser, quality of and depth of management is not as high, and management and shareholding overlap, CEO and MD being same, right? Investors, one advantage here you have is that in the private companies, investors have a long-term vision because they don't have to report to the shareholders. So this is a positive point, correct? Quality of financial and other information, it is less transparent, but the advantage is that you don't have to constantly be reporting. So that saves your time and cost. Correct? Taxes, private companies are more concerned with tax savings compared to the public companies. These are all company specific factors. Stock specific factors are related to liquidity. Remember, private companies are not listed, so they are, if you are a minority stakeholder, you cannot sell your shares. These are illiquid, and therefore we will apply liquidity discount. Correct. Also, restrictions on marketability means they have agreements that will stop shareholders from selling their shares, right? These restrictions again will put a strain on the liquidity of the company when it comes to trading the stock. So this is liquidity. These are stock specific factors. Also, if you are going to be a minority shareholder, you have lack of control. At the end of the topic, we are going to discuss discount for lack of liquidity and control premium. These are the two components which we are going to discuss when we are valuing a private company compared to a public company, right? Now, how to value a private business? Okay. First, we need to be clear that why are we valuing a private company? There are three reasons for valuing such companies, correct? One is related to transaction. Transaction is where you're going to raise capital or you need funds. You need to probably go for getting enough funds for expansion. The second is compliance, and third is litigation. Everyone, these are the three reasons for which people do the valuation of the private companies. Transaction means, let's say there is a funding round by the startup, right? So VC based capital financing is coming up for that, or if the company is planning to go from private to public, in those cases we require the company's valuation, right? There are various other reasons like mergers and acquisition, bankruptcy proceedings, or you want to give shareholder compensation. In those cases you will require to value the share which is not listed, correct? Compliance related is for financial reporting, where we are going to do the impairment testing, goodwill reporting, goodwill impairment testing. For that we'll have to value the company, right? Or stock based compensation. Tax purposes also comes under compliance valuation, where an individual who's a sole proprietor is planning to sell off this company stake and give it to their beneficiaries. For that also we might require the compulsory valuation. These are compliance related valuation. Litigation is when there is a shareholder suit between the partners, or if the partners are husband and wife, and if there is a divorce settlement, in that case we will require the valuation. So these are the various reasons due to which we require the valuation of the private companies, right? Here we need to understand what is normalized earnings. Very important concepts, right? We are in our reading number 6, private companies valuation, where we are going to discuss what is normalized earnings. Now, this normalized earning is not the same as what we calculated before. This is also adjusted for some very interesting thing. Here we are going to, of course, exclude the non-recurring and unusual items, but we also need to adjust for the stuffs that the private companies do. Remember, private companies artificially inflate the expenses, reduce the taxes and all those things, right? Or they might increase the owner's compensation to get a tax benefit. All of this, or because many of these owners are family members. So normalized earnings are adjusted earnings for of course, we discussed in the past, these are adjusted for non-recurring non-recurring items, and also for unusual items, non-recurring and unusual items. Now, these non-recurring and unusual items, of course, we discussed in the past, it can be due to gain or loss on sale of asset. That is fine. But here, the additional adjustment is due to discretionary or tax motivated expenses. So here, these non-recurring and unusual items can be due to discretionary. We use a word discretionary and tax related motivation. So see this tax motivation expenses and discretionary. So discretionary or tax, basically the objective is to save the taxes. So tax motivated expenses. So these will be provided to us in the question that, let's say, the compensation. Basically, the examples here are related to compensation is inflated or expenses are inflated, correct? So we might have to adjust for the rent or compensation, or basically the companies do what? They inflate the expenses so that they have to pay less taxes, or they put the earnings very low. So inflate expenses or artificially low the revenue or income. Artificial low artificially the income. This is what, when I say discretionary or tax motivated related expenses, this is what we need to adjust only in case of the valuation of private companies. We don't do that in case of public companies, right? This is what, there will be several adjustment related to property. We will see that in the examples. Companies using personal, using company assets for personal reasons. Here, for one of the example, I will just show you. Gross compensation is 2.5 million, correct? Right? But analyst determines market based compensation is only 1 million. So they are overpaying themselves. So when I will take over these companies, these expenses will be reduced from 2 million, right? So you will notice that we have reduced these expenses. So expenses should be reduced. So we have reduced these expenses. Similarly, if they have overvalued some things, for example, office building is not needed for core operation. So what should we do? We should not take office building into consideration. So any expenses related to that should be reduced from the company's profitability. This is what all adjustments we will have to do. Correct, everyone? Right? No problem. We will be given up in the question to do all those adjustments. So we will accordingly do those adjustments. Finally, when we are going to do the cash flow estimation, remember, a company which is not listed, estimating cash flow is going to be more difficult for such companies because companies haven't published their financial statements. So deriving the free cash flow is much more complicated here for the private company. And also it does matter that whether the private company is going to continue as a going concern, or it is going to shut down, or it is going for IPO. Then the things might completely change. Okay. So there will be multiple scenarios and analyst must assign different possibility or different probability. So cash flow estimation is going to be very complicated in case of FCFF or FCFE, whatever valuation you use. It is going to be relatively more complicated, correct? Also remember, here free cash flow is subject to, here it is more, FCFF is more appropriate when the company's capital structure is going to change, which is very much possible in case of these companies. So here FCFF model is relatively more preferred rather than FCFE. Understood? So FCFF model is preferred. Clear? However, remember at the beginning, I told you there are two relevant discounts that are applicable here. The discount for liquidity and premium for the control, right? So we are going to use that discounting for the liquidity and all. But before that, when we are going to value the private companies, we will use a weighted average cost of capital and for the whole company. But when we are going to value the equity, here normally we use CAPM, correct? But can I use CAPM here for a private company which is not listed? Because to find the CAPM, in the CAPM, I require the beta. Beta of the equity is covariance over the variance. Covariance and variances are derived from returns, and returns are derived from the past prices. But if the company is not listed, I cannot get the price. So getting a beta, or basically, trying to derive a CAPM is difficult in the private company's valuation, right? So therefore, should I use CAPM or not? Okay. In fact, some of the US courts have rejected the use of CAPM. Why? Because how is CAPM possible in such a case? So what we use is that we use another approach of the CAPM, which is where with CAPM traditionally estimated from a public firm data. So of course, this is not acceptable in the US code, but we may use a public firm's data, lever unlever for it. This is this lever unlever, and then we will compare it for the private company. This is not a part of your syllabus. You do not have to memorize this for your exam. But when I say lever unlever, we are going to use asset beta, that is the unlevered beta of the proxy company which is listed. Let's say I had given you the example in the class. Let's say I'm going to value a company called ADNOC, which is an oil and gas company in Abu Dhabi. It's not listed. So if I want to value, I will use a proxy company, Saudi Aramco, which is listed. I will have to use their asset beta, which is the unlevered, adjust for my company's debt equity, the leverage and taxes. Then I will get the beta equity. This lever unlever stuff is generally used when we use the CAPM model. Remember, these type of adjustments are generally not accepted in many of the courts, including the US code. All right. So private company valuation, we are going to use different approaches, but of course, we are going to use three major approaches: free cash flow, capitalized cash flow, and excess earnings. So let me first show you what are the three approaches that we are going to use. See here: income approach, market approach, and asset-based approach. Within the income approach, there is going to be free cash flow approach, which we generally use. Capitalized cash flow is constant growth rate, and excess earnings method. All of this. Now you will see me jumping from here and there. So what actually happened in the topic is that first we use the valuation approach. In that, the discounting rate, there are varieties. So either you can focus first on the discounting rates, different types of discounting rates used by private companies, and then you can focus on the different valuation approaches. So first, when I said the different discounting rate, for that right now we are focusing on the discounting rate. So I'll first go to the discounting rate. We use a CAPM approach, everyone in the class, and we use expanded CAPM approach and the build-up approach. These three approaches we will use to find the discounting rate. Remember, these discounting rate are called required rate of return. This is very complicated for a private company. So I will write down all the discounting rates. One is a simple CAPM approach, which is rejected by many because it is not feasible, where we are going to use RF plus risk premium, that is RM minus RF, into the beta. Here we can use the beta for proxy company, but then we use the second and the third approach, that is an expanded CAPM. Expanded CAPM, which is a more accurate approach, is it adjusts for the size and other company specific risks which are more relevant for an unlisted company. So it adds a size premium and unsystematic risk premium, which is a company specific risk premium. So it does take the original CAPM into consideration. Plus we add two types of premium. Premium for the size and company specific risk, or so called as unsystematic risk. Unsystematic risk premium. These two we add when it comes to the discounting rate of a private company. The third is a much broad and a much detailed approach, is a build-up approach. In the build-up approach, you will see what we are going to do is that this is the model used when there is no possible comparable public company. In that, we will use the similar approach like what we did in expanded CAPM. Here, we are going to do what? We are going to take we are not, when it is not possible to find a comparable, we are going to assume the beta is implicitly 1 and then adjust for the size, marketability, or any other premium. So here we are going to adjust for size, for industry factor. Why? Because we might take the beta of the index, which is always 1. Correct? And then the company specific factor. So yes, in the build-up approach, what will happen is that we will use risk-free plus we use the market risk premium, which is RM minus RF, correct? Market risk premium, but into the beta we use is 1. So we assume we are using a broad index, and therefore there comes industry related premium also, which was not there in expanded CAPM, where we assume that the peer companies in the same industry. So here one more premium is added, is the industry risk premium, compared to the two already that we did, that is due to the size and company specific risk premium. These two risk premiums are okay, which we already did, correct? These all risk premiums are fine. But the industry risk premium is added because we are assuming that we are taking the CAPM of a broad market, which is always where the beta is always 1. So you can simply take market risk premium, you can ignore the 1. Correct, everyone? This is used generally when you do not have a comparable company available. These are the different discounting rate approaches that you need to take into consideration. You don't have to remember the lever unlever beta approach at all. You can go into the derivation. I've already discussed that in the full course, right? These are the different ways of estimating the discounting rates. But remember, whenever we are using the discounting rates, you need to adjust the discounts for two things: for the liquidity of the stock, and whether you are going to take a control as a minority or as a controlling stake. So this is where you are going to now discuss whether this valuation, there needs to be some adjustment in the valuations. So these valuation adjustments are related to the, adjustments in the discounting rate. These are the two adjustments in the discounting rate that we do. Is one, we use the discounting for lack of control and for lack of marketability. So I'll first discuss that discount for lack of control, and then you have discount for lack of marketability, and then you can combine both. You may have both. So total discount is basically a combination of both. What is discount for lack of control and lack of marketability? Let me discuss that. Lack of control means if you're going to be a minority shareholder, you will have less control, isn't it? Because you will not have enough power on the decision making, especially if it's a private company. So the shareholder rights are not as protected in a private company compared to a public company, right? Correct. So here, what do I need to do? I need to either add if I'm going to take control, or I need to increase the discounting rate. Correct. So discount for lack of control, the formula, they have presented the formula, but I use a different formula. So generally I use discount for lack of control as a formula. They have used the formula. We will use control premium over 1 plus control premium. You can use this. So what happens? Control premium. Now, control premium, if they give you control premium, this is what they've done, 25%. So 25 divided by 1.25, that is what will give you 20%. This is the discount. Why discount? If the control premium is 25%, this is the discount that I will apply. And when I say I will apply the discounts, what will happen in this case? See here, everyone in the class. So without a voice, minority shareholders cannot determine the investment policies, and therefore firm that will exercise an IPO or sale are less likely to pursue action that damage the minority shareholders, if that is going to be the case. So if there is going to be a takeover or something, then this discount won't apply, right? Because the estimates of lack of control of discount are not easily available, we back out this information out of control premium observed in the public company takeover transaction. So we take the control premium from the recent takeover transactions, and we reverse calculate to find what is the discount for lack of control. This discount for lack of control, or the control premium, will be provided, and you can find the discount for lack of control. Discount for lack of marketability is basically due to the stock being unlisted, and there are some restrictions on you to not sell the shares, especially let's say after the IPO, your shares are locked, etc. So that is called discount for marketability. These are when you cannot sell the shares easily. So Together, what is going to be my total discount? My total discount is not additive, it is cumulative. So basically, we do 1 minus my total discount. Total discount is 1 minus we do the discount for lack of control and discount for lack of marketability, right? So it is 1 minus discount for lack of control minus 1 minus discount for market control or marketability. So discount for lack of marketabilities. This together will be my total discount. So when I take both, what is going to be my total discount? My total discount will be a combination of both. So here we don't add it. It's a cumulative function. So we have to adjust for both, for lack of control and lack of marketability. This will happen when both are present. If they give you both, you will have to adjust for both of them. Correct? Right? So let's say its discount for lack of control is 20%, marketability is 13%. So it won't be 20 plus 13, it won't be 33, right? So it is going to be cumulative, correct? So this is going to be total discount, very important formula. Now, it does matter whether there is the control, whether the company which is going to take over this particular company, right? Is it going to have a controlling stake or a minority stake? So see here, if the subject company is having a, in the valuation of the subject, so here whether I should add a premium or a discount, correct? What should I do? So if the comparable company has a controlling interest and the subject, in the subject also I'm going to take a controlling stake, then there needs to be no adjustment. Similarly, if there is a non-controlling company and has a non-controlling stake, then there is no adjustment. But if the comparable company has a controlling stake and it is taking a subject which has a non-controlling stake, so in this case, I will dominate the company or I will not dominate the company. So what is going to happen that in this case, the acquirer, is a controlling in its own company, but in this company, it is going to be a minority shareholder. So then there will be application of lack of control. So there will be a discount. But the acquirer is a small company or a non-controlling stakeholder, but it is going to take a controlling stake in the subject, then it will add a control premium. So whenever the subject has controlling stake, you add a premium. But whenever the subject company, in that company you're going to be a minority shareholder, you do the discount. You will not add a premium, but you will adjust for discounting. So your cash flows and everything might be adjusted for this discount. So whenever we do the valuation, we will adjust for this discount. So this will reduce our valuation. Understood, everyone? So whatever is the value, we will reduce that valuation by this discount. Very important. For example, see this. Now, assuming the sale is going to be likely and it is unlikely. So when it is likely, correct, the firm's equity value, we got this, minority interest is right. We did not apply for lack of control because when the sale is going to be likely, the controller will not try to dominate the minority shareholder. But when it is unlikely, we did apply the discount. So what happened here? Value of the minority interest without discount was this, and then we applied for the discount and lack of control. So what happened here? The firm's equity value in this case was 10 million. Here it was considered 9 million only. So the smaller value of minority interest is due to higher discount due to the lack of control and marketability. This is what we had discussed in the class, right? So the valuation reduces when the sale is unlikely, then you will be facing up the discounts rather than the control premium. Clear? Now, the last thing that we had to discuss in this is what are the different types of valuation approaches. Now, when it comes to valuation approaches, the three broad valuation approaches are the same that we did for public company: income-based approach, cash flow-based approach, market-based, and asset-based approach comes into the play because there is a possibility that the company might shut down. So in this case, we are going to use the three types of valuation approach. The first one being here, the income approaches. Income approaches where within that we have the free cash flow method. So I'm going to use the valuation, discounting and valuation. Remember, valuation of private companies. The first approach is income-based approach. Now, within the income-based, you have free cash flow approach. You have the approach that you exactly did in the past. So the income-based approach has three parts. That is the free cash flow. When I say free cash flow, is basically FCFE based model, correct? The free cash flow method. Then there is something called capitalized approach. Here, the income approach, we have in the income approach, let my screen be visible. Free cash flow method, right? We can use multi-stage, but the capitalized cash flow method is a constant growth rate. It's exactly the same. It's a constant growth rate model. So capitalized approach, cash flow approach. This is what I can say, two-stage FCFF. This is a constant FCFF model. No difference. It's exactly the same. This is a two-stage or multi-stage. This capitalized cash flow is a constant growth model. But the third model is similar to residual income approach, which is called excess earnings method. Okay. So the first two, I'm not going into the detail of formula, which we already are aware. But the third approach is what is called excess earnings approach. Now, let me just show what's happened to my screen. Yes. Excess earnings. Where is excess earnings approach? Yes. Excess earnings method. This is a very interesting approach. Here we need to find what is the excess earnings. So how do I find excess earnings? So there are steps. There is a 4-step process. We basically have to find the value of the firm, which is the value of the capital invested in the company, which is working capital and fixed capital, but also the value of intangible assets. So excess earnings, the analyst starts with earnings that should be generated by working and fixed capital. Yes, based on the required return. So what is the minimum return required on the working and fixed capital? So our step number one is to find the required return, correct? Based on that, what is the minimum return that I need on working capital and fixed capital, correct? That we need to adjust from the normalized earning. That's how we get the excess earning, similar to residual income. So there are actually 4-step process to find the excess earnings. So first I will make understand how to find excess earnings. Excess earnings. So we will first derive what is excess earnings. Excess earning is normalized earnings. Normalized earnings. From this, we will adjust for the required return. The required return on two forms of capital, fixed capital and working capital. Whatever is the required return for fixed and working capital, after deducting that, whatever is extra is called excess earnings, same like residual income. Now this earnings for a particular year, and we assume it will be generated forever. So what we do is that we are going to take the present value of this excess earning, which is called value of intangible assets. This is called value of intangible assets. Yes, which is nothing but present value of the excess earnings. So imagine this excess earnings that we got here. This excess earnings for the current year, same way like the Gordon's growth approach, we will use 1 plus G growth rate over cost of equity minus growth rate. Similar to that, instead of dividend or free cash flow, we have used here excess earnings. Similar to residual income, correct? Cost of equity minus the growth rate. Now, this value of intangible that we get, plus if I combine this with the value of working capital and fixed capital, value of working capital and fixed capital required or capex required, these three things put together will give me the total value of the company. So yes, first I will derive the value of intangibles or the excess, the present value of the future excess earnings. Combine that with the fixed and working capital, that will give me the value of the firm. This is a very different approach, excess earnings method, not there in any other models that we used in the past. Clear, everyone? Right? Right? Same approach we've discussed in the past. These are the models based on the, remember, we are doing income based models, okay? Then you have the market based models, income based and market approach models, or market approach valuation model. Under this, we are going to use similar to what we did in the past, PE based, we are going to use price to earnings or price to sales. But remember here, the price is not available because the company is not listed. So when we look at the market based approach, income approach, we saw all the three approach. What is there in the market approaches? In the market approaches, we use two broader method. In fact, the third method is just based on the past. It's guideline public company method and guideline transaction method. See, look at the market approach, similar to price multiples, which is difficult here. So therefore, we use what? We use guideline public company method and guideline transaction method. Guideline public company method, GPCM, and guideline transaction, which is based on the past transaction, GPCM, guideline public company method, guideline transaction method. And then there is one more method, which actually they have erased right now, is a prior transaction approach. Guideline public company method. Remember here, the name itself is the answer. You're going to compare your company with a relevant public company available. So you have to find the identical public company, right? Adjust for the, you can use the PE ratio of the identical company or the price to sales ratio. Here they have mentioned us that if the comparable company is relatively small in size, then you can use C. If the company is relatively small in size, then you can use a P approach. If it is very small, then you can use a price to sales. Understood? So the private company, if it is small, you use P approach. If it is very small, you use price to sales approach, because then the earnings are very volatile. But if it's a large private company, then you use the EV EBITDA approach. So you can use price earnings, price to sales, or EV EBITDA approach, right? This is you use when it's a very small company, you use price to sales. When it is small, you use price to earnings. When it is large company, you use EV EBITDA approaches. Clear, everyone? Right? This is your guideline public company method. You will take the public company's information. Now you can use it for transaction also, but just remember, when I use the public company's valuation, what happens in those public companies? These public companies, I need to adjust for differences. But one more, apart from those differences which we already discussed, when we are going to take a controlling stake, we will have to add the control premium, because the public company there might not have a control premium. So we might have to add a control premium, okay, if there is going to be a controlling stake. So control premium need to be added in this case, and the valuation, you need to do the same process. So there is not going to be any difference in the method, but I will just reuse it. This is to be perhaps used in all approaches, all approach. Okay. But if it's a guideline public company method, you need to adjust for control premium. However, if it's a guideline transaction method, remember past transactions already have a control premium inbuilt into it. So we need not separately adjust for the control premium. If it's a guideline transaction method, just remember no additional adjustment for control premium. So no adjustment for control premium, no adjustment for control premium. So even if they give me control premium, we will not adjust because the past transaction already take the adjustment for control premium. So that is not needed to be considered, right? And then you can use whichever ratios they give you. Just a small thing that I had added in the class is the prior transaction approach is basically similar to the guideline transaction. Here we take the company's own private transactions if they happen in the past. So it is the subject company's past transactions if we have that data. Otherwise, if we don't have any such past transaction, then this valuation approach is useless. So there are three approaches: market approach, income approach, and third is in the case when the company is going to be liquidated. That is what we call as asset-based valuation approach, right? This is the last approach, asset-based valuation approach. This I saw recently. It is no more a part of our, notes. I don't know why. It was there till last year. So in the asset-based approach, what we are going to do, we are simply going to find the company's NAV, which is total asset minus total liability, similar to what we did in level one. This is going to be the minimum value, which is what we call as the floor value. This is generally the last value that the company has, assuming the company is going to get liquidated. Here we take the total asset and total liability based not on the book value, but based on the fair market value. Correct? So here, this is going to be the lowest valuation amongst all the valuation. And this here, the assets and liabilities are done at fair valuation. The valuation is done at fair valuation. Correct? That is the last approach. Perfect. So these are the different approaches, correct? Based on that, I had given this extra note as prior transaction and NAV based valuation, which was not there previously. Correct? I've got a question. Why am I not using WACC? Where should I use WACC? Please tell me WACC. When you're valuing equity, you don't need to do WACC. When you are valuing equity, you need to use the discounting rate as cost of equity. Correct? When you're valuing the whole firm, only then you use WACC. Understood? So that's a repeated thing. Just for the information, I have a question that I missed out on the topic of discounting rate. No, we actually covered the discounting rate. All the discounting rates are your cost of equity. Why? Because we are directly valuing the equity. We are not using the FCFF approach and deriving the company's valuation. Even in the approach of income based, we are using FCFE. So FCFE requires cost of equity, not WACC. So therefore, we have not missed on the discounting rate. The discounting rate we covered, you can use CAPM, expanded CAPM, or the build-up approach. Always, only if you're using FCFF approach, then you require WACC. Otherwise, you don't require WACC. Got it? Clear? Perfect. All the formulas covered, right? Don't worry, all the formula will be shared. This is where we covered almost every point that is essential. I know it's a lengthy 4.5, 5 hour session, but this is where we covered each and every point. This is where we close the equity part. Almost covered. My suggestion is whatever I covered in this session, you also, that will help you quickly cover in 4-5 hours. When you do self-study, you'll cover all of this in 3-4 hours. But if you have planned to, let's say, allocate an entire day, that's where you can read in between the lines all of these components. Or you can just watch the video at 1.5 speed. Within 3 hours, you will finish everything writing with me. Correct? Correct. Any questions till this point? Right. That's the end of all your topics of equity. One of the lengthiest topics of all the 6 readings. How many pages have we done for the formula? Almost 22 pages for formula till this, right? From the first reading. Clear, everyone? Okay. Thank you.